All right, everything looking good. Should be live. All right, let's get this stream rolling. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is 8 p.m. Eastern Standard Time on March 16th, 2022. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So everything looking good. Somebody let me know in the comments you can hear me loud and clear, or just say what's up, or possibly a combination of the two would be absolutely wonderful. But in the meantime, looks like we are good to go. So let's go ahead and get this party started. So obviously we had a big day today, FOMC meeting. Powell spoke afterwards and, essentially did exactly what we expected. He gave us some, appreciate that, brother. Gave us a little bit of forward guidance as to, what the Federal Reserve plans to do going into the future. And as expected, as predicted, as basically laid out perfectly by Fed Chair Jay Powell, they did exactly what they said. So they have completed their asset purchases. There are no longer any asset purchases taking place, in addition to replacing those that are running off the balance sheet on a regular basis. So previously they were buying a ton of mortgage-backed securities and treasuries. Now they're not buying additional ones, increasing the size of the balance sheet. So they have stopped the increase of the size of the balance sheet. And then in the future, they have announced that they will be, probably next meeting, working out a plan to start decreasing, not actually selling assets off the balance sheet into the open market, but rather just allowing them to roll off. So normally what takes place is, as the short-term items on the balance sheet expire, they would just repurchase new ones to take their place, thus just maintaining the size of the balance sheet, which currently is like $9 trillion. So it's massive. So what they're expected to do going into the future is to let some of those roll off. So rather than selling, they're just not going to purchase new ones. So essentially, as they mature, the balance sheet will just slowly get smaller and smaller. So that has the same type of effect, but in a different way. So rather than selling into the market, creating excess demand, they're just not buying what they would normally be buying, therefore decreasing demand, which essentially does the exact same thing, or increasing supply by not swooping up that supply. So again, it's just like the bathtub analogy where, it doesn't matter if you, have water flowing into the bathtub's half full. If you turn up the speed on the water, but don't do anything with the drain, and it's just draining out, it will slowly fill up if it's draining slower than it fills up. And the same thing the other way around. If you leave the water flowing in at the same, but you open the drain up more, it will drain out faster than the water is filling it up. So you can kind of balance between those two things, between the drain and between the faucet. So think of the asset purchases as the faucet filling the balance sheet up, and then think of the drain as, the assets running off of the balance sheet. So it's sort of like, both those numbers are important, how much they're buying and how much they're letting expire or selling. But at the same time, they essentially do the same thing. Because if you just close the drain and you turn off the water, whatever water's in there, however much is on the balance sheet, just stays there. But since naturally it will drain on its own because you have short-term, duration, bonds, etc., whatever's on the balance sheet expiring, there's always some water kind of draining out. There's always some balance kind of draining off the balance sheet. So therefore, there's always sort of a nonstop kind of, flow of water in as well as down the drain. But previously, for the last 2 years, the Fed has been buying a ridiculous amount of assets, in the form of mortgage-backed securities and treasuries. So they basically had the water on full blast for the last 2 years straight. And now the bathtub is twice the size it's ever been, full of water. So instead of putting the drain open super big to let that water drain out in a hurry, all they're doing is they're just shutting the water off completely. So now no new water is coming in, and then will slowly just kind of trickle out down the drain at the regular pace that it normally would. They're just not replacing it. So hopefully that analogy helps a little bit. Now, granted, we have stopped the water flow in completely right now, for now. But they normally would still trickle in a little more water to fill what's draining out. But now they haven't actually made that announcement yet, but they gave forward guidance that in the future, maybe at the next Fed, meeting, that they might start to allow some things to expire off the balance sheet. So maybe later on, if say, for instance, if there was like $10 billion worth of assets expiring, instead of buying back all 10 billion in new assets to keep the balance sheet the same size, maybe they'll buy back 9 billion, or maybe they'll buy back 8 billion. So they'll let the balance sheet slowly just kind of run off on its own. So that's what they're saying is going to happen into the future. But what they actually did was just a 25 basis point hike, 0.25% on the Fed funds rate, which is nothing, because we know currently the most recent CPI reading, the inflation rate, consumer price index, was 7.9%. So the real rate currently, as of right now, just with the most recent number, not like the median rate, not the average over the last couple of years, not any of that stuff, just literally what it was with this 25 basis point hike and the 7.9% most recent CPI number. You just would subtract the 0.25 from the 7.9. So it's 65. So the real rate right now is 7.65 negative. It's negative. Now that's an annualized rate. So that means over the period of a year, if you're just sitting on cash, your cash is losing 7.65% purchasing power. Or what, 7.64? Yeah, no, 7.65. So you're losing 7.65% purchasing power if you just put your money in the bank, leave it there, etc. So in all reality, that's why, people like Ray Dalio or whoever will say cash is trash. You don't want to be in that. It slowly just deflates away your buying power, etc., etc. But we know that the cash is not a savings account that we're just sitting away for 100 years and then one day we're going to give to our kids. We know the cash is our way to, essentially buy puts on the market. So, we're basically taking out an option, and the option is that by keeping cash instead of investing that money, that we're anticipating something in the market that we want to buy, whether it's crypto, whether it's stocks, whether it's houses, whether it's, whatever you spend your money on, cheeseburgers, prostitutes, it doesn't matter. You're assuming that in the future, you're going to be able to buy those things for less than you're buying them for now. So something's going to go on sale in the next year or 6 months or 3 months or whatever. So that's where our option comes in on that. So we know we have massively negative real rates. So basically, the Fed has given us some forward guidance as to what is going to happen in the future, what they're expecting, essentially how many rate hikes they're expecting, and they do that via the dot plot, etc. So let's take a look at a couple of those, and then we're going to jump into our typical stuff that we look at. So if you didn't catch it today, I highly recommend you go back and watch it. You can kind of hear the overall tone. Obviously, the markets responded fairly bullish to it leading up to it and then afterwards. But there was nothing bullish there, in my opinion. As a matter of fact, it was rather bearish because, realistically, the market wants Powell to look like he's in the control for the first time in 2 years. And instead, he came out and, he tried to act like he's in control. But, let's be real. The Fed has completely, they haven't lost control because they could easily just jack up the rate as high as they wanted and crush inflation. But they won't. They can't. They're just enjoying it right now. In my opinion, the Fed doesn't want to stop inflation. They've literally been trying to get inflation for the last, 20, 30, 40 years. Their mandate for the last, 10 years has been to try to get 2% inflation, and they failed every year, nonstop, constantly. So why all of a sudden they finally have that inflation and they're just going to milk it for all it's worth? And who suffers? Well, obviously poor and middle class people, but hey, according to Jay Powell, he's like, look, I know it sucks, but you know what? We're going to get it under control. He kept saying our mandate is price stability, and we'll get there eventually. So just hang on. What a piece of shit. But anyway, so let's take a look at the 10 year. So obviously this is forward looking. So the 10 year is going to try to price in what it's expecting to happen. But in all reality, all this is just, this is basically just the yield you would get on a 10-year treasury. So if you were to go out and give the government your money for 10 years and you say, here, government, take my $1,000. And the government says, awesome, I will pay you whatever the fixed rate on a 10-year yield is at the time. And then based on the actual price of the bond that you purchase throughout its life cycle will basically affect the actual yield itself. So currently the yield is 2.187. Okay, so it's a real yield with a 6.7% CPI just for this month, not averaging out over the year, etc. Or 7.9. I'm sorry, with 7.9. Assuming that just stayed the same and it was just fixed, and it just did that for the next year, and then you bought this bond, and this was your fixed rate, whatever, you would be basically yielding the 7.9% is the inflation minus the 2.18% that you're getting paid. So you're losing 5.713% every single year for the next 10 years. And so we know, obviously, if you lose 5% a year for the next 10 years, that takes away a significant amount of your purchasing power. Therefore, nobody would want to tie up their money for long periods of time, which is why nobody wants to buy the 30-year treasuries, which is why the yield curve starts to flatten out, because the yield curve is like, 2.7 on the 30-year, and then it's, 2.18 on the 10-year, and you're like, well, I barely get any more, and I have to guarantee that you hold my money for 30 years instead of 10. I'll just do the shorter duration. And then you look at the 2-year, and you're like, well, I get 2% just tying it up for 2 years, and then I can reassess later on, so I'll just do that. And then you keep going down the yield curve to shorter and shorter duration, and that's where the Fed actually affects the Fed funds rate. Is basically like we're talking about like now the difference between a 30-year treasury bond or investment or loan to the government versus like an overnight funds rate, which is what the actual Fed funds rate is. It's like the overnight settlement rate between banks or institutions that have an account with the Federal Reserve. So here we see, now that we kind of lay that back out, we see this is hitting now new cycle highs, okay, which is 2.187. And then when we go back in time, we see the last time we were at that level was on the way down in June of 2019. And then we know if we just keep scrolling back here, we have actually reached now the area from January of 2009. So people say like, oh, the rate can never go to this, can never go to that. Well, we're back at 2009 rates. And when we go to a long enough time frame on this, we know that all this ever does is go down. We know all it ever does is go down. I mean, it's just getting absolutely crushed. So now let's look at this, because I want to make some connections long term on why this is so important before we get to the actual dot plot and everything. And I know this stuff is boring, and I know it's complicated, and it's like, man, who gives a shit? Give me the tickers, bro. Tell me what to buy. But this is the most important thing, because this is literally, we always talk about the two of the most important things in the economy are energy, because it's the price of making stuff, moving stuff, like life and functionality of the human race and existence as a whole. Energy is so important because it goes into everything. And then, what's half of every single transaction is money. Every time something is bought or sold, it's money, it's currency, it's whatever. So, this is the rate is essentially how much it costs for that money. So it's so damn important. So, I know it's not like the most exciting topic out there, but, you start mastering this type of stuff, and, you're going to have a much better grasp on, where your money should be and what's really happening. And then we can figure out what all the smart money, the big money, the whales, the institutions, where they're putting their money, and, and what's the risk reward, what's the benefit of doing this or that, etc. So, and that's what this is all about. That's what all this technical analysis is all about. It's not about just being fun and guessing right. It's about figuring out what the smart money is doing so we can position ourselves with them so we can just ride their wave. Because we don't want to be fighting the markets. We do not want to be fighting the markets ever, because we'll lose every time. Every time. You cannot go up against the whales. You can't go up against governments, market makers, Federal Reserves, central bank institutions, etc. You cannot. They're too big. We're all too small. Even together, we are literally nothingness. So here we look at the monthly chart on the 10-year treasury yield, and we know going back to, obviously this was the last time we had inflation, was 1981, back through this Paul Volcker era, and we were basically at, the Fed funds rate was like at 19% or something like that. And, the 10-year treasury was yielding 15.8%. I mean, can you imagine? Would you invest in the stock market if you could just take your money, lock it away, and earn 15.8% per year? So the point that people always talk about, or they say, is that as the rates go down and down and down and down and down, people have to move further out the risk curve. And what they mean is, in order to get a decent amount of money or a decent amount of interest or, currency paid on your investments or on your loans or whatever, that you have to start speculating on more risky and more risky and more risky things. You can't just take the safety bet and put your money in treasuries, like that old school, 80-20 portfolio or 60-40 or 50-50. Now, most people have very little bonds or no bonds unless they're like, full on boomer status or retired or whatever. Most young people are like, yeah, right, I would never own a bond. And I'm not saying I disagree with that. In the words of Peter Schiff, they're, reward free risk. You risk everything and for a fact you get nothing. You will lose. So if you're getting a negative real rate on bonds, why would you ever invest in them? Well, there's your answer right there. So essentially, what we're looking at here is, a perpetual just meltdown. And we know obviously this is inverse to the actual bonds themselves. So we know if this has just been melting down over the last 40 years, we know bonds have just been going absolutely parabolic. 40-year bond market, bull market. So the average life of like an investor on Wall Street is like 25 years. So if this has been going on for 40 years, that means that literally like no one that's an investor, a financial advisor, anybody that's basically been in these markets that's not like just a straight up OG has never actually functioned, has never invested, had never been involved in a market, without, a complete meltdown in yields or complete parabolic uptrend in bonds. They've never experienced real, long lasting inflation ever in their lifetimes, for the most part, let alone in their investing careers. If we're going back 40 years and then you have to be old enough to be an investor, even if you were 20 years old at the time, you'd have to be 60 years old. Well, most people that are 60 years old are, on the verge of retiring or whatever. So maybe, they got into it 20 years, they have 5 years of experience in that, and then they have now another 40 years of experiencing this. So now we have recency bias on top of everything. So even the people that did experience it back in the day think, oh, that'll never happen again. It hasn't done that for 40 years. Things are different now. This time's different. It will never happen. Rates can't go up. This is the first time in 40 years we've had inflation. So this is super, super important to realize this time really is different. Whether we like it or not, whether we want to admit it or not, this is the first time in 40 years we've had inflation. So going back to it now. So here's our monthly chart, just a complete meltdown. And each of these peaks is very important because it aligns with those various recessions that we're paying attention to. So we know that every time we have a couple different lines on this chart just for the various ways that I've drawn it, whether we're looking at like log scale or regular scale. Obviously we can switch back and forth. And when we do that, when we switch from log, the horizontal or the descending channel that we have lines up perfectly, obviously, with this peak right here, this peak right here, this peak right here, the whole way down. Exactly. So it would reason to say that we're going to move back up to the top of the range. We're going to peak at this green resistance line. And then once we peak at the green resistance line, we're probably going to get rejected. Well, where's that green resistance line? Well, this is the monthly right now on the 10-year treasury yield. So, that's a pretty thick and juicy green candle. And where are we at? Well, we're at our target. That's been our target since back down here. And now we're there. We made it. So one of two things is going to happen. Okay. This is either going to get rejected and come back down and continue trading inside the channel. It's going to pop up, come up to the 200 exponential and simple, and then it's going to get rejected, or it's going to have a confirmed breakout where it actually like goes higher. So you guys know, obviously, we've had this target in place, this big red box. That's been our target for what? At this point in time, it's, over a year and some change. Well, we're there now. Okay, so what happens? Well, we have to wait. We have to find out. But if this is forward looking and we're just now going into an uptrend, we just now have switched over the monthly blue slope on the TJD TDMACD. We're just now inside the bullish control zone on the Jewel Thief. We're now actually getting ready to retest the 200 exponential and simple on the monthly. The 8 and 21 are in a parabolic uptrend. This trend is accelerating to the upside. When the candles keep getting bigger one after another, that means we're accelerating to the upside. The trend is strengthening to the upside. So as of now, the trend is strengthening to the upside. We've already reached our first target. Our next target is the 200 exponential and simple. I would say there's a very high probability, possibility, whatever, that we get there. So we're at 2.18% right now. Going into the beginning of this month, we were at 1.7, somewhere around there. So I think we go to 2.67%, Now, do we likely get rejected there? Yeah, we probably do. We probably do. And then if we break out above that level, that means something changed. Because one, we've never done that. We haven't done that we haven't been above the 200 exponential and simple since 1985. So how likely does that seem? Not very likely, right? So I would say if we broke above 2.664% on the 10-year treasury, I would say there's something crazy going on. Like, it's like, oh shit, this is a change in trend. This is a technical breakout. This is a big fucking deal. That's when we want to get in, right? That's what we look for. We look for the change in trend, either the top or the bottom, to make sure that we get the hell out. But we wait for confirmation. Now in this case, we picked the bottom. We made some investments accordingly. That's fine. We can speculate on stuff like that based on shorter time frames. But on a monthly trend that's lasted for 40 years, if we get positioned in advance for that trend, it's likely to play out for, if it's 40 years down, I mean, even if it retraces back to the upside and then eventually goes negative, I mean, what are we looking at? 2 years, 5 years, 10 years? I mean, 20, 30, 40, who knows? I mean, we'll have to wait and see, obviously, but this is where we want to be. So, I mean, the slope on this is decelerating. I mean, it's still going down, but, it's starting to kind of flatten out. We're headed up to it to retest it. We probably get rejected. But we know if we break above 2.7 on the 10-year, something is up, and it's a big deal. So now look at this last peak right here, because this is super important. Where are we at right here? 3.18%. That was at 2018, when they were on autopilot, and then Powell crashed the market, basically like right around Christmas time. And then after that, completely melted down, cutting rates, everything, all that stuff. And then, then we went into COVID. I mean, it just so happens all this stuff lines up. I mean, it's definitely just a complete coincidence, I'm sure, that the market, that the economy couldn't handle it. I'm sure it was a complete coincidence. And they definitely didn't use, a crisis and not let it go to waste by injecting trillions of dollars in liquidity into, the markets, the economy, directly to consumers. There's no way. That was just all complete coincidence. 100%. I'm sure. I mean, there's no way there was, any kind of manipulation or shady tactics there was definitely not like an agenda behind the scenes or anything like that. I would never, ever suggest that there was some strange conspiracy theory or, basically that they, use that opportunity to do something different. I would never suggest that, obviously. I mean, we're not conspiracy theorists here. We use math and science. So that's our key level to pay attention to, that 3.16. I mean, this is a big deal if we break above this, but if we take out that previous high, that's a big fucking deal. Because if we take this out, now we're back at levels from 2011. Because this one's a lower high. That was a higher high than rejection. Okay, so let's just remember that number in our heads, 3.18%. Okay, and we're in a very, very bullish short-term retracement of a very, very bearish downtrend. So we're still bearish on the macro, on the monthly, but we're bullish for that retest and then probably rejection. So 2.7 and 3. Let's say just 3.2 to be simple. All right, so that we know that. So now let's go over, how do we want to do this? Which order do we want to go in? Let's go to some of the charts from today's Fed Powell's little bullshit meeting, and his never-ending lies and complete just being a total little bitch. So here's our PCE inflation, okay? So this is obviously, all the Fed gets together and they all vote, and then everybody puts in, basically their projection for, what is inflation going to look like going out into the next year, 2 years, 3 years, and then longer run, okay? So obviously they haven't been able to reach 2%, going in 2018, and then it was just slowly melting down. No inflation. They were actually fighting deflation. We were down to almost 1% inflation, which is half what they wanted. And then look, it's gone absolutely parabolic since then. I mean, nothing to do with certain presidents being in office, obviously. It's total coincidence that obviously this was when Joe Biden took office, and policy has nothing to do with this. This was all completely because of the Rona. This had nothing to do with world economics, like policy, global supply chains, policy on energy. None of that affected any of this at all. This is all just completely, random because of the Rona. So with that assumption in mind, which obviously is, that's not my view. I'm not a moron, so I don't believe that. But if that was what you were going off, which is fine, we could just presume that. It doesn't really matter whose fault it is. But we know we have ridiculous amount of inflation. So if this is going out, and granted, this is not completely accurate right now because this level is like 5.5% on this chart right here. So really, we know we're at like 6.9%. So in all actuality, it should be, the line should be like up here. Okay. So let's just pretend it's up here, but we'll just use this number for now. So here is basically the way this projection works. Everybody votes, they put in their stuff, they kind of fill out the box right here, which is the central tendency, is where like most of the people voted. The median is basically just, the average of where it all comes out and fits into place. And then the range is, the guy who picked inflation is going to be the highest next year. The guy who, or girl, who picked that inflation is going to be the lowest next year. And then we kind of get an idea as to what their projections are. Okay. So knowing that right now we're at, let's say 5.5 based on this chart, but really we know it's 6.9. But, we're going to average that out for the whole year when it's all said and done. So that's why this number appears to be lower than the actual rate currently going into, 2022, et cetera. So we know we have the last year's rate averaged out to, whatever, 5.5, let's say. Into the future, they figure by the time 2022, which we're in right now, by the time this is all done and we print out these numbers, and 22 finishes and they average it all out and they figured out the highest projection that anyone will have for inflation is going to be 5.5%. So we're at 7.9% right now. So for every month that we're at 7.9% or 7% or 9% or 10%, we need another month that is equally less than that to put us back at that number. So if we're going to get back down to 5.5 and we just did a 7.9, we need a month that's 2.4% below, 2.4 below. So if we're 5, that means we need some months with like, 3.3%, 3.2%, 2.5%. So we need to average this out for the whole year. So just knowing right now what the inflation's like and everything, the realistic projection of the highest one being 5.5% seems a little iffy right now. So, and then on the low end, we have people that voted here and said, oh, it's probably going to be like 3.5%. So if we just do the simple math on that, and we know, obviously, we're in March right now, we know that we have more inflation coming into the future, obviously, because the energy price spike that we just had because of, the war and whatnot hasn't even been factored into these numbers. This is basically just like January, February numbers. And now we're, midway through March. We know realistically that we're probably going to see like, 8, 9, 10% print on CPI. So that means that if we're going to get down to 3% and we have months that print like 7, 8, 9, 10%, that means we need to have literally like months with zero. Because if we have one month that's, let's say we're going to try to get down to 3.5% and we're going to print a 7%, we need a month with zero to balance that out, right? Because 7 plus 0 divided by, 2 is 3.5. So that's obviously not going to happen. We're not going to have months with zero inflation unless we have some deflation or something taking place. But realistically, let's say in a more realistic way that let's say we have 1 month at, 7%, and then we're going to average out to 3.5%. So we have 2 months where it's lower, but still not at zero. You know what I mean? Let's say it's 2% for a couple months. So now we have, 4 plus 7 is 11, then divided by 3, and then we're basically closer to like that 3.5%. So for every month that we're at 7, we need 2 months that are basically at 2. So if we start printing 7.9s or 9s or 10s or higher, we know that it's going to be damn near impossible because we're going to run out of months before we can average down to 3.5. So that being said, the median or average is somewhere around like 4.25% for this year when it plays out. Obviously, we have some closer to 4.5. We have some closer to like 4.0, somewhere around there. So you can decide for yourself how realistic these projections are, how realistic, how likely this is to actually take place. And keep in mind, this is going to be the whole year. So when we start averaging that out, I mean, you can create a little graph, a little chart, and you can start doing your own calculations and say, okay, if the first month of this year, we were at, 6.5%, and now we're at 6.9%. And then let's say next month we, have 7.5%. Then what does the rest of the year need to be to average out the entire year to get down to 3.5%? Is it possible? What about 5.5%? And then you can get a realistic idea and you can track along with this throughout the months of the year and see how likely is this to actually play out. And I'm going to tell you right now, it's fucking bullshit. That's my opinion. Because if you start doing the math on this, like we just did, you know that every month that goes by, if we need 2 months to balance out one really bad month, that means that by the 4th month of this year, we'll have 8 months to balance out 4 months. to bring it down to that even amount. So if we have 4 bad months to start off the year, unless those next 8 months are really, really, really low, we don't have enough months in the year to average down to like 3.5% or 4% or 4.5%. So either the Federal Reserve is complete moron retards, or they're complete liars, or they're just dumb as fuck. I mean, that's what it comes down to, because obviously this is not realistic. We know that for a fact. And now keep in mind also that these PCE numbers that we get are year over year. So what is the Fed expecting? What are they going off of that lets them give this low of inflation rates averaging out? And we'll get to that in a second. So keep that in your mind, that that's our question that we're thinking about. And then going into 2023, we have our highest estimate at like 3.5%. We have the lower end of the range at like, say, 2.25%. And then the median is basically right at about 2.5, 2.75, somewhere around there, between like 2 and 3, higher end of 2, lower end of, higher end of 2, let's say. So what does that mean? That means by the time we get to here, the entire year is going to average out to somewhere, let's say, between 2 and 3%. So not only is inflation going to peak, it's going to be coming down fast, because we know we're at, 7.9% right now. So, basically a year from now and then into the whole next year, it's going to average down to like 2%. And then we know by 2024, everybody's like, oh, it's going to be 2% again. There's maybe one guy who's like, dude, it's still going to be 3%. Don't lie to yourselves. And then, by longer run after that, it's like, oh, the Fed's going to get it under control. Everything's going to be back to normal. Everybody agrees we'll be back to 2%. They all just get together and they're like, yep, 2%, because we are successful. We're good at our jobs. I mean, they're not, obviously, but they think they are. So they're like, yeah, we'll get it back down to 2%. It'll average out to 2%, over time, because that's a made up number. There's no way to actually measure things like saying over time, etc. So that's their projection for PCE inflation. You can make your own judgment for how realistic this is. And are they completely delusional? Or is there something here that maybe, they are a little delusional, but also that they're not being upfront about, or that they assume people are too stupid to understand? So now let's figure out what it is that people are too stupid to understand. Matter of fact, we're going to skip over to, this one, and then we'll come back, because this is what's so important. So this is on the FRED data from Federal Reserve Economic Data. You can go look this up yourself. This is the median consumer price index. So it's a CPI, but it's basically the average. And you can see like full description down here and everything. But this is basically just core inflation. Obviously, if you live different places or you buy different goods, there's going to be like slight different numbers, etc. But this will go up and give us our 2021 numbers. So this goes up until 2022 of February. So the most recent data is basically in here and has this month's data at 6.5% for February 2022 and had it at 7.1 for January of 2022. So, obviously something changed, calculation or whatever they decide that they average out, that it actually like came down a little bit. That's fine. That's irrelevant, because a little bit of a difference in the number discrepancy makes no difference. When we look at this chart, though, we know going back to 1982, 1983, whatever, as long as we can go back on this chart, we know that this is the highest it's ever been. Inflation is literally the highest it's ever been on the median consumer price index. So, we had a couple peaks back here right around recession, a peak back here right around recession, and then we had a peak right here, came down a little bit, and then peak again, and that led into a recession. And that was obviously some key times in history, 2008, 2000, 1991, etc. But we don't want to look at all that. We've been through all that stuff a million times. Let's look at this, because this is going to answer the question, is the Fed morons? Are they liars? Are they delusional? Do they think we're stupid? Which one is it? Is this whole transitory thing bullshit? Or is there really something to it? Like, we can get down to the nitty gritty, because this is just the look over the 1 year period. So this is to current February 2022, most current data. And then it goes back 1 year from February 2021. So the way the CPI is calculated is it's year over year. So when they give us that 7.9% CPI read, it's really just 7.9% over last year. It's not over like some median of like a 10-year period. It's not like an average. It's literally just like what was last year's number averaged out, and then this year's number averaged out So we saw back here, it was 2.5% back in February of 2021. So it was already above average. It was well above average because, you know, if you're looking for 2% over time as the average and you're at 2.5%, well, you're 25% higher than you're supposed to be. And then if we look into March, it went down to 2.0%. So it was where it was supposed to be. And then after that, we just went, you know, 2.75, 3.59, 3.99. 2.76, and then we just kept just going, you know, parabolic. I mean, this is, if this was an asset that you could invest in, you would want to buy inflation, right? Because it's clearly going up and to the right. You know, it might be in a small retracement currently, but, you know, it looks like it's going parabolic to me. Now, is this our 5-wave structure, and then we're going to retrace the 5 waves and come down? Well, we'll have to wait and see. But that's not what we're here for. What we're here for is to figure out if the Fed is delusional or what's going on. Because we know when this March data hits, that they're going to have a 2% base that comes off of that number because it's year over year number. So realistically, we were up 2% in March of 2021, and we're probably going to be up over 8% this month. But what they're counting on is that the inflation was so bad at the beginning of 2021 that it's actually going to start subtracting inflation off of the current inflation. So the Fed is basically hoping that if they wait long enough and just slowly move, that not that the actual prices will go down, not that you'll be able to buy more stuff with your money. They're hoping that the year over year numbers will come down because the old inflation is rising faster than the new inflation, if that makes sense. Because each time we look at that number, it's going to be calculated year over year. So when we get to June, there was a 3.99%, 4% inflation in June. So if we're at, let's say we're at 8% when we get to June, well, we're going to subtract out that 4%. So then we'll only be at 4% as long as we don't keep having worse inflation. So that is what the Fed is banking on. That's what they're betting on. That's what they're hoping on. They're praying on. So that's why it seems like they're not doing anything and just choking, which they are. They're totally choking because they're just praying, and they have been for the last couple of years, that eventually they'll be right. They're like, if we just don't do anything long enough and we just freeze, eventually things will just go back to normal. We've manipulated everything so badly that now we're afraid to stop manipulating it because we're going to crash it. So we're just going to see if it just goes away. That's what they're basically hoping for. And their argument behind it going away, and the whole transitory argument is that it will not that it will stop going up. We're going to still have tons of inflation. It's still going to be inflation like crazy because of supply chain, because of policy, because of, you know, whatever you want to blame it on, money supply, you know, aliens, wars, you know, food shortages. You blame it on whatever you want. It doesn't really matter. None of that matters. The reason of it. What matters is they're assuming that the rate of change that the inflation keeps coming in at goes down. Now, the only problem with that is that in, you know, this was our February number from last year was 2.5%. And then obviously we have our February number from this year, which was 6.5%, you know, real year over year. So next month it's supposed to come down. It comes down to 2. So it loses, you know, basically 20%. Goes from 2.5 to 2. Well, what's going to happen next month? Well, next month we're going to have in all the data from the extremely high food prices and extremely high oil energy prices because of everything going on right now over in Russia, Ukraine. So the next number that we get, this number that falls off, is going to be down by 0.5%. And then the number that comes in is going to be up by what? I mean, 2, 3, 4%? I don't know. I don't know exactly. I know it's going to be a lot. I mean, how much did things go up this past month? I mean, gas went up over here like 80 cents. And I think it was like $3.20 before that. You know, so we're talking about like 25%. So, you know, and that's obviously a big chunk of it. The used cars are still expensive. You know, all kinds of energy still expensive. Food still expensive. All the stuff that's in this is still going up. So if we have this next month's going to come down, and then our next month, you know, coming onto the chart is going to go up. We, you know, when we take out this 2%, but instead we get a read of 10%, it's still going to put us at 8%. Or if we get a read of 12%, it's still going to put us at 10%. So essentially, it's going to get worse before it gets better. We know that for sure. Now, what happens a month after that, month after that, month after that? Well, if it doesn't keep rising faster than the previous year's inflation was rising, which we know it's basically just been going parabolic for the last year. So eventually, they're just like, well, if we just wait long enough and it doesn't just keep getting worse, eventually it gets better. because it's year-over-year numbers. So hopefully I didn't go too far into that, but I think it's very, very important to understand. I talk about a lot of times about understanding the data that's being presented to you, because they can easily use statistics to manipulate you and lie to you. And the most important thing to understand is when we get these numbers, are they just flat numbers? Are they year-over-year numbers? Are they seasonally adjusted? Are they, how is this data being presented? And we need to fully understand that so that we can understand the relationship to what's going on, because all this is relative. The inflation is all relative. So that is the whole breakdown from that. And then we're actually going to get into, should we do this one next? No, all right, so we're going to come back to that. So now we're going to branch off for a second. We've looked at inflation. We looked at, the Fed data. We looked at the 2-year, 10-year. We're going to talk about the other piece of data that was basically presented. So this is the dot plot for essentially what they're expecting going into the future. So we looked at what the inflation is going to be based on their projections. This is what the Fed funds rate is going to be based on their projections. So then when we take the Fed funds rate and we subtract that from the inflation rate, we get the real rate, either positive or negative. Most likely negative, obviously, because we know that the inflation rate's so high. So we know what their numbers were going into, the next couple of years. Now let's look at where they expect the actual Fed funds rate to be going into the next few years. So obviously each of the members votes, and then each of them, this is their dot where they voted, and then they look at it and then they figure out, where the median is, etc. So in this case, 2022, they figure by the end of 2022, our low end estimate is like probably 375 or something like that. And our high end estimate is, 3.125 or something like that. So let's say just roughly 1.5% and 3%. And then everybody else kind of voted somewhere in the middle. Most of them feel like probably it's going to be around 2%, maybe slightly less than 2%. And then going into 2023, the Fed funds rate is going to be at over 2% is the highest, or is the lowest rather. And then the highest is at 3.75%. And the median is close to like 2.753%. So they're saying that the Fed funds rate in 2022 is going to be around 2%. And then in 2023, the Fed funds rate is going to be around 3%. And then in 2024, it's going to be right around 3% still. And then it's going to start coming down in the long run, just over 2%. And then that's going to help combat inflation. And then just the inflation is just going to run off eventually, because it's going to stop going up faster than it's going down. So eventually it's just going to start running off the back end. So the rate of change, though things will be getting more expensive, they'll be getting more expensive at a slower rate. Therefore, the annualized inflation rate over the previous year will look lower. So if something was $100 the first year, and then there's 5% inflation, now it's 105, and then the next year there's 5% inflation again, you now have 5% of the 100 plus the 5 extra that's added onto the price of something. So if in the next year after that it's down 4% and it's not quite 5%, then it's another $4 on top of the 105 plus the whatever it works out to, like extra 20 cents or whatever. So then it goes up by $4.20. So then that same good was 100, then it was 105, then it was 109.20, and then say the year after that it's only 3%. Then you take the 109.20 and then 3% of that, and then so the price of that good is still going up, but it's going up slower than it was the last couple of years leading into it. And that's what the Fed is hoping for. That's what they're praying for. That's what they're assuming is going to happen. So this chart right here tells us that in order to achieve this goal of theirs, that somehow this year they're going to combat, what is almost 8% inflation right now and rising, and will be rising next month. Will probably closer to like 9 or 10% if they actually don't doctor the data crazy as hell. We can assume that they're counting on a 2% Fed funds rate combating what amounts to the first 3 years of the year, 3 months of the year at, let's say, our first month was like 6.4 or 6.5, and now we're at 6.9. I'm sorry, 7. I can't even keep track of these numbers. We got trillions, we got ridiculous inflation rates. 7.4, I think, was the first number this year. I can't remember. And now we have 7.9. And then next month it's probably going to be like, let's say low end, 8.5, 8.6. So then when we try to average that out by the whole rest of the year, somehow this 2% Fed funds rate is going to combat that. Okay, sure. I believe you. You're right. You guys got a bunch of economists, 500 plus people, smartest people in the world, highly paid. You guys are central bankers. I'm just a guy on YouTube, so sure, I believe you. You're right. Okay, so if they are right, let's just assume that the Fed is not complete retards, total liars, or they actually know what they're doing. Let's just assume all of that stuff. Let's assume they know what they're doing and they're going to be right into the future. Let's assume that this is right. You know, maybe not the high end, maybe not the low end, but somewhere around in the middle. So we're going to assume that the Fed funds rate at the end of this year is going to be around 2%. And then the Fed funds rate at the end of 2023 is going to be around 3%, and then 3%, and then it's going to slowly come down. Sure. Okay, I believe you. That's fine. So now let's look back at some of our old data from before we had inflation and then see how realistic does this seem and what is that going to look like, you know, in comparison to what we've seen in the past. So, oh, sorry, wrong one. That's the one we want. Okay, so this is our monthly chart of the 210, you know, obviously like flipping and everything. I should have put one on here with the Fed funds rate. Let's use this one so it's not as complicated. Okay, so we know basically, you know, based on our recessions and everything. Damn, I thought I had actually prepared one more chart, but that's okay. That's okay. We don't need to know the exact Fed funds rate because we know obviously that the 2 and the 10 and all the other yields are going to be in relation to whatever the Fed funds rate was leading into that. So essentially, if we know now we're at that 2.187 level on the monthly 10-year treasury yield, and that was essentially the average that we had through, you know, basically like this 2011 period till about 2017. Half the price action below it, half above it, you know, and then right around at it, below it, above it. So we average out to around the same level. And then we know the entire time it's been dropping. And then obviously we had our spike going in right here where it was around 3%. And that's on our you know, 10-year. And that every time the yield curve flattens out and basically the 2 and 10 invert, and we know the Fed is controlling the short end of the curve, we know that essentially what's happening is that the Fed funds rate is gaining so much that it's actually like catching up to or even passing, which is the inversion of the yield curve. So whether we're looking at a 3-month, whether we're looking at the overnight rate, whether we're looking at the 210, etc., you know, it's kind of showing us that same thing. So this is our chart for each of these white lines is when we entered into recession. And then the green line here is the 2-year yield. The orange line here is our 10-year yield. And then we can kind of see, you know, when it inverts and then it leads to like a recession, etc. But we don't even have to see the inversion. We can just look at the overall trend. Obviously, it's in a downtrend, obviously. But we know whenever the TJD master switches to the upside and we see the green trend on the monthly go up here, around when it crosses back to the downside is right around when we have our recession. So, you know, it's peaking out and starting to roll over. That's when we go into our recession because, you know, the rates obviously had to come back down. So they caught up to each other, you know, tag, you're it now. Now we're going back down. So if we know that's happening and we know, obviously, I mean, you can see this, the 2 years approaching the 10 extremely fast. I mean, the gap back here in January of 2021, the 2-year was at 0.11. And then at that same time frame, the 10-year was at 1.0. And now the 2-year is at 1.92 and the 10-year is at 2.16. So the spread is literally like, you know, 0.24, 24 basis points, 0.25%. So we're very, very close to the yield curve inversion, as expected. But there's no signs of recessions, and the economy is strong. We know that. But the actual Fed funds rate is just now getting its first 25 basis point hike after this. But that's just the market. That's just the market. It knows what's going to happen. It's forward looking. Everything's fine. Nothing to see here. Fed's got this under control. We're trusting them, remember. Okay. And then at the end, we can make our own speculations. But for this example, we're just going to trust them. We're going to trust that they're right and they're smart and they know what they're doing. And they're not going to just completely fuck everything up. So let's look at this chart right here now for a second and see where did this top out at in October of 2018. And then let's look back and see on a longer time frame here Go back to 2018. What did I say? October of 2018. So in October of 2018, the CPI was around 2.29% back then. But we know now, we're up here in like the 6, 7. And then when we look at this chart again, we know that that was basically when the market couldn't take it anymore. And the 2 and 10 inverted. And then we went into recession and essentially crashed. So we also know that, so the max between the 2 and the 10, essentially, the max it got up to was like 2.8 and 3.1. So now let's look at the Fed's, targets for where we're going to be at into the future. So this year, we're going to be average around 2.0. But next year, we're going to be roughly around what? Roughly around 3%, right? 2.83%. So that's an important number, remember. Because once we pass, once we pass this previous peak right here, shit gets serious, right? So if this peak was at 3.16, and we know that they're planning on being at 3% in 2023, this can do whatever it wants for the next year. It doesn't matter. But in 2023, if Fed funds rate's at 3%, the 2 and the 10 year are going to be higher than that, or else the yield curve's already inverted. So it's not just going to keep pumping inverted. Eventually it'll roll back over, but that is going to take out this top. So if the Fed knows what they're talking about, if they're right, if everything they're assuming and all their like super smart, just amazing minds have all come together and they're like, yeah, we fucking got this and we're right. And then let's just assume that future us came back from the future and said, I don't know how they did it, but Jay Powell and those goons over at the Fed, they were right. They totally nailed it. All the numbers they were giving, their estimates, everything was completely correct. And I say, really? It was all completely correct. What's the future look like? He's like, oh, you don't want to know, bro. Because what that means is that we took out this previous peak. So that means that for, obviously we've topped out and rolled over every time we got above the 200 exponential and simple, on the 2 year or the 10 year, or that resistance line. This was our 2 10-year resistance from that other chart that we had, the top of that range. So if we take out this top right here, what is that? Well, it's a technical breakout of our resistance. It's a technical breakout taking out the previous top. What happens every time we're in a downtrend and we get a technical breakout? Well, you get some kind of measured move to the upside, usually a pretty aggressive one. So if you're in a downtrend and then all of a sudden you get a technical breakout of that downtrend, you usually get a pretty aggressive move back to the upside, the technical breakout, and then you resume the downtrend. Sure, okay, that's fine. Well, if that happens, what is that going to look like here? What's it going to look like on this chart? And again, this is just back to the 10 on the monthly, so it's not quite as, convoluted or whatever. Let's turn back on our drawing tools. What is that going to look like? Well, if we break out to the upside and we get, our measure move already, which is this inverted head and shoulders or cup and handle, that's the completion of our measure move, which keep in mind, these targets and all this pattern and everything drawn in here, I know it looks like crap on the monthly. Keep in mind, this is over a year old targets and everything in place and resistance and measure moves to the upside. And this is our initial measure move breakout of our inverted head and shoulders or cup and handle, however you want to look at it. Well, that arrow takes us up to the measure move up to 3%. Well, what is 3%? Oh, that's the number we were just talking about. Okay, and then where are we at now? Well, we've already broken out. We confirmed that breakout. We confirmed the head and shoulders. We confirmed the cup and handle, and we're already halfway through. We're already halfway done. We've already made it back to 618, which is the internal retracement from the previous peak in 2018 to the bottom in 2020. So we've already had a 61.8% retracement of that move. So the next target to the upside, which just so happens to line up with the 200 exponential and simple, is the 786, the top of our red box range right here, and the majority of the move of the measure move. So then that's 2.65%. And remember what the Fed expects into 2023. Well, they expect us to be up at 3%. So if the Fed funds rate's over 3%, that's going to be, basically a complete retrace of this move and a technical breakout. We'll take out that previous level. And then at that point in time, what will we have done? We'll have broken out of a 40-year downtrend. We're close to it already right now. So if we even break out to the 786 and retest 200 exponential and simple, which we have done historically over and over again, along the entire way down. If that happens, that's already a technical breakout. And then if this level holds and we get the actual move of the channel itself, which is what our technical breakout usually is, it's the measure move from the bottom of the channel to the top of the channel. And that's what this blue arrow right here is. if we get that technical breakout, that takes us up to like 5% Fed funds rate, which is going to put mortgages, a few percentage higher than that. We're talking about 7%, 8%, 9%, 10% home mortgages, car loans, a couple percent over that. If credit card are at, interest rates are at 18, 19% right now at zero Fed funds rate, let's just add, 2%, 3%, 5% to that. Maybe you got a bad credit card, so you're already at 25%. So call it 30, 35, maybe 40%. I mean, what does this do for your ability to service debt? And what does the economy look like going into the future? So the Fed is right. If everything they said is right, and we make it above 3%, and then we maintain above that level, because the Fed is genius and they know what they're talking about, and we maintain at or above 3% going into 2024, what does that look like for the economy? Well, that puts us up here, a technical breakout. And then what happens with the technical breakout? Then we get a measure, move, retrace of the actual, channel that we've been inside of. So what does that actually look like for the economy? What does that look like for asset prices, for homes, for cars, for stocks, for whatever? And I'm not trying to be bearish right here. I'm just saying, if something's been in a downtrend for 40 years and then we break out of that downtrend, it wouldn't be that unrealistic to think that we get an aggressive move to the upside. So now let's pay attention to the long-term measure move. So here we have from the 40-year trend, which we're paying attention to, going back to 1981, and then we have a fib drawn to the bottom right here. I'm going to make this nice and thick and juicy so you guys can see this real well. So that's our big red Fibonacci from the top right here to, basically our Rona dump low. Okay, so now let's look at where our 236 is. Well, our 236 is at 4%. So the typical retracement, the initial retracement, the most, shallow retracement you can have is the 236. So if we break out and we decide to do a first level Fibonacci retracement and then continue to the downside, that's 4%. If we make it up to the 382, that's 6.3%. The 382 is the most shallow of your traditional retracements. So the 236 tends to validate that the fib target is real and you have a swing high and a swing low. And then the 382 is your typical most shallow retracement. Obviously the 0.5, Charles Dow theory, and then the 618, is the most that you want to have and still continue that trend. So there's some potential targets going into the future. 4%, 6.3%, 8%, and 10%. Do we want to live in a world where those are the Fed funds rates, where that's the 2 10-year treasury yield? I don't know. I don't know what it looks like. Okay. No one does, because, most of us weren't in the markets back in 1986, 82. Most of us, a lot of people, I shouldn't say most of us, a lot of people weren't alive or definitely didn't care about this shit. So if the Fed is right, if everything they presume is correct, if all their data is correct, if all their little, nerd brains get together and they all sit in a room and everything they came up with is correct, and then we do get our 3%, and then we invalidate this previous high, we get a technical breakout, and then we move up to our next previous swing before that, and that just so happens to also be the 1.618 Fibonacci extension of the breakout right here. The 1.236 lines up with the 382 of the macro fib in red. I mean, is it realistic to think that we make it up to 5% Fed funds rate? Maybe inflation gets a little out of hand. Maybe not. I don't know. I mean, we'll see. Is that just a break-even rate? Is that still going to be negative? I don't know how bad it's going to be. I don't know how bad anything's going to be. I don't know that we even get there. But if the Fed is right and we get up to 3%, that's a technical breakout. And I know what happens when we get a technical breakout. And if there's one chart that I've ever seen for 40 years that's trading technically, I mean, does this look like a technical chart to you? Does it look like it bounces off these key fib levels? Does that look like a bounce off a fib level? Does that look like a bounce off a fib level? Here we kind of overshoot it a little bit, but then what about that one? What about the support right here? What about this bounce? What about that one? Yeah, I mean, is this just random? Is this random luck? Did that just randomly bottom right there? Did it randomly top right there? I mean, is this trading extremely, extremely technically? I would say yes. I would say it's trading extremely, extremely technically. So when we see this happening after we put in a swing and we look back at it and we say, were the bots, were the algorithms, were the market makers, were the whales, were they trading technically off what looks like this is probably, a macro swing high and a macro swing low? I would say yes. Therefore, my main target, my initial target for a breakout, for a technical breakout of this descending range is 4%. So the Fed is anticipating 3%. That's a technical breakout of, our descending channel above the 200 exponential and simple and taking out our previous swing high from 2018. So at that point in time, it seems very, very likely that we get continuation to the 236 of the macro, which is 4%. And then at that point in time, who knows what happens? Who knows how many years it goes for? Who knows what the economy looks like? Maybe the aliens come by then and then, they completely invalidate technical analysis. I don't know. Maybe this all happens in the next 6 months and it doesn't even take that long. Maybe it takes 10 years, but it happens. Maybe the dollar loses its reserve currency status. Maybe there's World War III and we're all living in Mad Max world and there's no internet. I don't know. I don't know what's going to happen, but I know what this chart is telling us. I know that if we do break out right here, that we're probably going to 4%. I know the Fed is anticipating 3%, and we know the Fed is always wrong. So if the Fed thinks they're going to have to be at 3%, and they've done nothing for the last 2 years, and inflation's raging, and everything's going, to shit for a lot of people, gas prices, food, energy, housing, some of the most important things that people need. I know that the likelihood seems to me that the Fed is a bunch of dumbass retards and they don't know shit. And that we're probably smarter than they are because we're actually looking at data. They're just saying, we feel, we think, we hope, we're anticipating, we're praying, we're frozen because we don't know what to do and we're just always wrong. Well, they don't say that, but that's what's happening. So I would say we're probably going to be right because we're looking at actual math and we have like a legitimate plan, a roadmap to how we get to these different numbers and how the Fed is wrong. So just remember, we're using, their data points and their estimations and everything. So is it possible that we get here and then we're at 3.5 and then actually it goes just slightly higher and then maybe like the median turns into like the actual real life situation and then maybe we don't come back down in 2024 and we continue to rise and then eventually we have a crash. Maybe we go into a recession, depression. I don't know. I don't know what's going to happen. But I know realistically that one of two things is going to happen, okay? Either inflation is going to run out of control and they're going to have to raise the Fed funds rate and we're going to break out of a 40-year downtrend and have an aggressive move to the upside and hit one of these measure moves, whether it's a 200 exponential and simple moving average, whether it's the previous swing high, whether it's a swing high before that, whether it's the measure move, one of those, the Fibonacci level, one of those things happens, or the other scenario, the only other possible scenario based on everything we've looked at today is that we come back up here, we actually never make it to those levels. The economy just totally takes a shit, falls on its face. The inflation numbers year over year start to come down aggressively because people don't have any money. We go into a horrible recession. The economy just completely dies. Everything rolls over. There's no demand because the economy is so shitty. Inflation rates through the roof. Nobody can afford anything. So finally the prices have to come down. The cure for higher prices is higher prices. So one of those two scenarios plays out. And here's our margin. This is the margin for us to be wrong right here. That's so back here it was like, well, I don't know. Maybe we'll be wrong because look at this margin for us to be wrong. And then it's like, well, it's starting to look, and then, oh, wait a minute. Oh, it's starting to look like we're goddamn geniuses. So we're pretty close right here to the yield curve inverting, especially at the speed and velocity that the 2-year is approaching the 10-year. Does it look like, can you picture a scenario where all of a sudden the 2-year just rolls over completely and then the 10-year just keeps going and then everything's just dandy and we just kind of go sideways and they don't cross and then, it just goes forever like that and it's just dandy and the economy's fine? Well, we could picture it in our head. We could fantasize about it, but that's not what happens, not in real life. So I would say there's a very high likelihood that one of those two scenarios plays out. Matter of fact, I would go as far as to say there's a 75% chance that one of those two things plays out. And if I had to guess, I would say it's a combination of those two things. And what is that? Well, that's stagflation. We go into a recession and we still have super high inflation. And then the Fed is forced to hike rates. And then that actually causes even more stagflation. So things are still expensive. They start to come down a little bit, but they're still accelerating, but at a slower speed. So we have a stagnating economy while we're suffering from inflation, which is basically like a death spiral. Because everything's getting more expensive and then the economy is still getting worse or, at least just going sideways, not getting better. And that leads to essentially just a worse, it's a worse life for most everybody because you're paying more for shit and the economy is not doing good. And every part of the world economy, for all of our lives has been based on growth. GDP increases, not decreases, not, recession or depression, but constant growth. So we rely on that. But I mean, what gets us out of that? It's not going to be rates. It's not going to be fiscal and monetary policy, because now they can't use direct injections, because that's going to cause inflation to go through the roof. So if they try to do that, they're going to be trying to fight inflation by giving you more money faster. They're hurry up and give them more money so they can go buy stuff to keep up with inflation. And then what's causing all the inflation? Well, policy, and then also obviously like quote unquote money printing. So that doesn't work. We know that doesn't work. So it has to be a combination of fiscal and monetary policy, but we know that we can't give out more cheap money, because that fucked everything up. So we need to have less cheap money or more expensive money, or, flush out some of this inflation. And the way to do that is going to be through a technical breakout to the upside, where the Fed has to go crazy and jack rates through the roof, or inflation just comes down kind of on its own, kind of because of supply chains, kind of because of policy, kind of because of Fed funds rates, but we just go into like a recession, maybe depression. So I can't see a scenario that isn't one of those two things. Now, maybe there's something I haven't thought of. Maybe the Fed will just be completely wrong and they'll just invalidate everything we've ever seen in history. But if the Fed is even kind of right, even a little bit right, we know what the future looks like. It looks like one of those scenarios. So that is essentially how I look at what happened with the Fed today, with their little 25-point basis, rate hike, what I expect next month. And what's going to happen next month? They're going to get a CPI reading through the roof, because it's going to have all these extra energy prices, all the extra food prices. We know, gas went up by like 25% in this past month because of, Putin tax or whatever you want to call it. That's what they're like spinning over here. So, maybe CPI goes up 1, 2, 3%, 25, 50, 75, 100, 200 basis points. I don't know what the number's going to look like. I'm sure they're going to try to doctor it, make it not look as bad. But regardless, next month is going to be bad, because we know, based on this chart right here, we know what the next month looked like last year. We know last year it came down, and we know this year's is going to go up for sure, because we know what the data was. We just haven't gotten it yet. So we know that one chart's going to be going up while the other one goes down. So that is going to exacerbate the gap in between, and the gap in between is what the CPI is, because it's calculated year over year. So we have 50 basis points. If it just went the same, just went sideways, it didn't get any worse, we know the CPI is going to go up by, 0.5%, 50 basis points, because it goes down by 50 basis points then. So that's going to be less, taking away from it. And then in all reality, we know it's going to go up by a couple basis points, or a couple percentage points too, because of the gas and food prices and everything. So, I mean, what are we looking at? An increase of 250 basis points, 2.5%. So we're going to go from 7.9% to, are we going to hit double digits? I don't know. I mean, I would say probably yes. Can they doctor the data enough that it doesn't look that bad? Yeah, I'm sure they can. So if they get the cooks in there, cooking the books, and then they get the doctor in there operating, I'm sure between everything, they can keep it at like, 9.3 or maybe 8.9 or some crazy number that's not true, obviously. But regardless, we know it's going to be higher. So next month, when the CPI comes out and it looks bad, and then they start looking at this dot plot and talking about what they're going to do, and are they going to do another 25 basis point hike? Because keep in mind, we're down here at 0.25. So another 25 basis point hike puts us here. And then, each meeting, basically every month and a half or so, they're going to have another one of these meetings, and they're going to potentially do another, rate hike. And they're pricing in 6, 7 rate hikes for the year at 25 basis points is basically 1.5% to 1.75%. Well, that puts them right here, 1.75%. That puts them right there. So that's about right. So if we get a bad number all of a sudden and they have to jump up and do a 50 basis point hike, what is that going to look like? They could still be on target for 2% by the, average out by the year or whatever, by the end of the year. But 50 basis point hikes is going to probably surprise the market and look bad. And I don't think they're going to be able to get away with another 25 basis point hike when the next month's numbers come out and look absolutely terrible. And inflation looks like it's just raging, even if it is about to roll over after that. Even if they're right, and afterwards we're going to take out 2% here, and then we're going to go back to taking out 2.7, and then we're going to take out 3.6, and then we're going to take out 4, and then it's like, okay, now we're starting to see the inflation rate come down because the inflation leading up to it was going up so fast. So that's what we're looking at. Remember, it's all relative to the year-over-year number. All right, so I'm going to take a quick drink, and then I will jump in the questions and holler at you guys and whatnot, answer any questions, whatever, and then we'll just get through our regular stuff. But I wanted to do a deep dive into that because I don't think that people are fully seeing what's going to happen. And, of course, I think the Fed will be wrong because they're morons. They're either lying or they're stupid or they're just wrong and they're not liars or stupid. So any one of those scenarios, or maybe they're completely right. But even if they're completely right, we know that we're still fucked. I mean, maybe not we specifically, but the economy, the world, poor people definitely are fucked. So we'll see what it looks like. All right, I'm going to take a quick drink and then we'll keep ripping. All right. And obviously, this is our oil chart right here, but, this was the oil, this was the oil spike for March. So, if oil went up from 96 to, 125, 130, whatever, we know it's roughly, average that out, 12.5 to, 30% increase. And we know, food's been going up too. We know, depending where you live, obviously natural gas is not as big a deal for us in the United States as it is for some other countries, but these are serious numbers, so we know what to expect, and it's not going to be good. All right, so Asoto says, loud and clear. Good to see you, brother. Appreciate you. Two idiots go sailing. Good to see you again, my friend. Not boring. Yeah, I don't think it's boring, but, I'm a finance nerd, so. But, hey, you start making money off something and understanding it truly and being able to get ahead of the curve and not believe all the bullshit. And, it starts getting real interesting real quick. Quinn Rivers says, it's not boring, it's really important, and you understand it better than I do, so it's great to hear your take on it. Hey, thank you, brother. I appreciate the kind words, and I'm glad that you guys are all here because you care, obviously. Crypto Galt says, hey, all, finally made it live. Happy St. Patty's Day, y'all. Oh, yeah, happy St. Patty's Day to everybody. I forgot to wish y'all the happy Patty's Day to all the sweet, sweet Irish out there. Mr. Lex says, hi. What's going on, brother? Good to see you. The Blockchain Bastard says, coincidence? Yeah, exactly. It's a complete coincidence, I'm sure. Quinn Rivers says, complete coincidence. He says, yeah, exactly, man. I don't want to get canceled by YouTube, so just picture your own air quotes. XX Angel says, hi, all. What's up, Angel? Good to see you. Body Development says, top-notch content. Great work, Crypto Trend Trader. Appreciate you, brother. Thank you for the kind words, all of you guys. Appreciate the community. We got an awesome community, obviously, but Peter Gerd says, we can grow old together. Watching the Fed funds rate break out. Yeah, we're not going to have to grow old, man. Where are you going to be a year from now? Really think it is great that you take the time to go through this. Yeah, I appreciate it, man. I'm glad that there are, 14 of you guys that care here live right now seeing it because, this is like, honestly, I don't want to hype it up too much or anything, but, this is the type of thing that can change your life. The moves that are going to potentially happen are going to happen going into the future. If I'm right, if the Fed's right, if one of these two situations plays out, we're going to be able to position ourselves for, probably one or multiple of the biggest bull markets ever in history. We have a 40-year bear market in Fed funds rate, 40-year bull market in bonds, in housing, and all this different stuff in the stock market. So, it sounds crazy when we talk about things like the Dow Jones gold, the Dow to gold ratio coming back into line at like 1-to-1 or 2-to-1 or something like that. But is it really that crazy to think if some of these situations play out that we have a stock market crash of 75% or that, gold could go up by 400%? It doesn't really sound that crazy when you think about like a 40-year or potentially 90-year, trend coming to an end when you're looking at something like the Dow Jones or something, or comparing it to like the Great Depression or recession or something like that. So, putting in the work now and taking the time, positioning, working out these scenarios, and then keeping a notebook, a scrapbook, a journal, whatever, and saying, okay, if this scenario plays out, what is going to do well in this scenario? If we're wrong and this opposite scenario plays out, what is going to do well in this scenario? Do I want to have cash so that I have the options to buy things if they go down? Do I not want to have cash because cash is going to go to zero? Do I want to have, US dollars? Or is the US dollar going to go away in the next 2 years, 3 years, 5 years? Do I want to have Russian rubles? I mean, look how that's played out. I mean, look at how many of these foreign currencies have basically gotten completely thrashed. While the whole world was saying how the dollar was going to get crushed, the dollar's been going absolutely parabolic, and all these other things have been getting crushed. So when everybody's saying that the bond market is the place to be, when the bond market gets crushed, where is all that money going to go? Is it going to go into crypto? Is it going to go into real estate? Is it going to go into gold? Is it going to get wiped off the face of the earth and people are just going to get absolutely decimated? Is it all going to go into the hands of a few people? I mean, probably. So being able to position ourselves is literally going to be, and again, I'm not trying to hype anybody up. Don't get too excited. This is all just, fun. We're having fun here. None of this is financial advice. I'm obviously not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. I have no clue what I'm doing. I'm just drawing funny things on a screen and just talking about not conspiracy theory things with you guys for entertainment purposes only. But if I'm right about, these entertainment purposes only things, and if Jay Powell and his buddies are right about, doing their jobs and how great things are going to be and how they're going to raise Fed funds rate to 3%, well, we might be able to make some assumptions based on that could probably, turn us, assuming we were to speculate on some of these things, we might live a pretty comfortable life. Queen River says, I've seriously been considering taking out all my investments now and just reassessing where I want to invest, trade, etc. Yeah, I mean, the most important thing to do is not make any sudden decisions and, figure out exactly what you want to do. But we'll do one more little analogy and then we're going to keep going from here. Man, what book is that? Damn, I can't think of it. Might be Mark Douglas. I wish I could think of it off the top of my head, but in one of, I think it's a trading psychology book, and I believe it's Mark Douglas, maybe Trading in the Zone or one of them. He talks about essentially the way that you can be successful at trading is by being successful at gambling, by figuring out risk reward ratio and all these different things that are parallels between the two. But the difference between gambling and trading is that when you go, or investing, whatever you want to say, depending, investing and trading, what's the difference? Well, probably the time frame, and that's about it. When you go to a poker table or you go play blackjack or you go play roulette or whatever it is, when you go, let's say you go over to, the blackjack table and you put down, $100 and you want to play this hand. So you put out $100. You get your cards, you play your hand. When the hand's over, you're either, you either won or you lost, but you're done. You're out of the game. And then if you want to play again, you have to ante up again. So if you won, you can just re-ante up your $100. You could ante up the $200, the 100 you just won, plus your old 100. But either way, you have to choose to participate again in the next hand. As where in trading, you make an investment and then you can win or you can lose, but you don't necessarily choose to participate. You have to choose to not participate. Because once you're in, you just stay in until you decide to sell or you decide to get back out. So that's one of the weird things about trading that people sometimes don't realize is that you're not just gambling once, getting in, getting out after you get that nut. A lot of times you're just getting in and then just kind of sitting there and then just hoping over time you're going to, win because you're in an uptrend. But imagine going to a roulette table, and I love roulette. It's one of my favorite games. Imagine going to a roulette table and just putting your money out there and then putting it on red, and then you win 1, 2, 3 hands, spins, and you just leave it. You're just leaving it on the same numbers. And you're not reassessing, you're not moving it around, you're not taking some back out, you're not putting it on different numbers or whatever. You're just leaving it on red, even, or whatever it is you decide to bet on. You're leaving on specific numbers saying, well, it'll probably hit 35 again, right? You would never do that. It sounds ridiculous. I mean, you might leave a couple dollars out there, but you're going to move some things around. You're going to shift your portfolio or your investments or your bets, whatever. And that's one thing that people don't realize about the psychology of, trading or investing versus gambling. With gambling, you realize like, okay, after I play this hand in poker, if I want to participate in the next hand, I have to put my ante up again. If I want to play this next hand of blackjack, I have to put my ante up again, etc. But with trading, you've anteed up, you're in, and you just keep participating until you choose not to. So sometimes it's intelligent to choose not to. Now, obviously, you have to take into account, tax, tax implications, etc. Whether you're trading in a tax deferred account or whether you're just trading in a regular account, all that stuff. Obviously, I'm not your accountant. You have to figure out all that stuff for yourself. But, and that's all factored in for sure. You should pay attention to all that stuff. But it's just a weird thing to think about, because once you think about that really, and you realize you're like, well, maybe I don't want to trade in and out of positions every day or every week or every month, but I definitely don't want to just sit in positions completely complacent and just ride out bear markets and downtrends. Not if I can easily see them coming. Not if we can predict them using like some kind of like indicator, that masters the market and completely determines the overall trend on any time frame. That's how I look at it. So, but anyway, I'm pretty sure that's Mark Douglas, Trading in the Zone. But I can obviously find that out for you, or you can just Google it. I mean, the analogy basically. But all right, so let's do some technical analysis. So we know oil. We're gonna do U.S. oil, WTI crude. We know we had like 3 peaks right here in our ascending broadening wedge. Very bullish, obviously above the 200 exponential and simple. And then obviously we broke out, went parabolic. This looks to me like a blow off top. Typically in a blow off top, what we see is a breakout, a technical breakout, a measure move to the upside, and then we engulf the entire breakout. And now this was the thing we were paying attention to is, does this hold when we come back down? Does this key Fibonacci level hold? Does the ascending, what was resistance, act now as support, and then we continue to the upside? Well, no, it didn't. We broke down from it. And we did it for a couple days now. Now, granted, we could wait and see how this looks on a weekly chart, but we know now we're about to get the 821 daily cross to the downside. We know now we've gotten the hard sell signal and left the bullish control zone. We know we have multiple red histograms in a row. Normally I pay attention to 2 and the loss of a key support level. We now have red slope on the TDMACD. So this tells me that, we probably have topped out short term on oil. Now, granted, obviously I said that, before it had this like big dump right here, but, I'd say now it looks even more likely. And then we know obviously that each of these bullish control zone, hard sell, off of resistance, bullish control zone, hard sell, off the resistance, bullish control zone, hard sell, off the resistance. And now here we are, we're leaving the bullish control zone, getting ready to print a hard sell. I mean, we're very close on this is a weekly chart. We're basically, we're at like 81.5 right now. When we get to 80, we'll print the hard sell signal, and then we'll have left the, it'll basically look exactly like this. We'll leave the bullish control zone and get the hard sell at the same spot. And then that tells us, realistically, each previous time we came all the way back down to the green support. Maybe we don't come all the way down to the green support. Maybe we just retest this previous high right here. So maybe we just come back down to 82. But what I'm looking for is a potential buying opportunity to, I took some profits along the way. I kept some of my positions open. I like to let some stuff ride, but obviously took quite a bit of profits along the way up at resistance here after the blow off top. And we hit our 114 target. I took quite a bit off the table there. And then now, I could buy back in right now and get 15% more for that same money because we took profits. Or we could wait and, potentially get back in at 83. Or maybe it gets wrecked and comes all the way back down to 200 exponential simple. Maybe get in at 70. I don't know what's going to happen. But right now, this looks bearish to me. So I would rather just kind of sit this out and see how everything goes. And then we'll get back in at a key time. Or we'll just start, dabbling back into it as we so choose. But so then the VIX, the VIX rolled over again, exactly what we're expecting. Once again, we have our technical breakout of the descending channel right here that we've been operating in since that Rona blow off top, obviously into the bullish control zone. And we know this corresponds when we make it into the red right here, that corresponds with complete capitulation in the market. When we get up to these levels on the VIX, we know that is a crash. That's a market crash. And then we know that this is a bullish pattern. Obviously it's an internal retracement of this big move right here, but we're basically just operating inside a descending channel. And we know eventually we're going to break out and get the measure move of the channel itself. And that's our measure move here in blue. But in the meantime, we started to form the ascending channel. So we have the resistance, support rather in white, and resistance here in white. And we know that each time we tagged that resistance, we came back down to, at least the bottom quartile of the pattern itself, or the channel itself rather. But we'll see right here, So I would expect us to come back down, retest the yellow breakout level, and potentially 200 exponential and simple somewhere around like 23, 24. And then at that point in time, a continuation of the upside. As far as I'm concerned, we have a high, a higher high, a higher high, a higher high. We have a low, a higher low, a higher low, and we're probably going to get one more higher low and see continuation to the upside. And then inside of that, we could start looking for something like this to play out. Do we find support, basically off of the 1, 2, 3 touches of that? Do we get a 4th touch right here? It kind of all lines up. Maybe this should be drawn a little bit different. And then, obviously this was our zone that we wanted to get into back here. This is obviously an old target. We didn't know when it was going to hit that, but it obviously did. And that's the beauty of having these things drawn in advance and seeing what our targets are, and then seeing how often does the market come to our target like it's our little bitch, like we're in control. I mean, I'd say pretty damn often. So when this comes back down here and we get that retest, that's going to look like an opportunity. So whether you're actually playing the VIX or not, what is that going to look like? Well, that's going to look like probably another top, a short-term top in the stock market, and then another move back up to the upside. And then probably if we take out this high, this high, this high, this high, it's probably going to be a new low in the S&P 500, corresponding obviously with the rest of the indexes, etc. So that's what I'm paying attention to. That's what I'm seeing right now. Seems very likely that we will get a situation like that. And then obviously we know this is our macro horizontal channel. And, essentially once we get that retrace down here and we find support, assuming that's what happens and we're right, and we get that support, we're going to come back up here. And then eventually we're probably going to run back into the top of the channel. We're probably going to run into, the bullish control zone, maybe even complete this move into here. And then that's when we're really going to be looking for, like market cycle bottoms and really looking to take strong positions. Now, we don't have to nail it exactly to the dollar, to the day, to the month, to the week. But we know that right now, while things look cheap, they look cheap relative to being extremely overpriced. They don't look cheap compared to like historical levels, not based on valuations, not based on, what could amount to potentially like 40-year highs in like interest rates or 10-year or 20-year highs, etc. So what are valuations going to look like at 3% Fed funds rate or 5%, or with the technical breakout of a 40-year downtrend in, yields? Or what happens if the bond market capitulates? We'll see. I mean, we don't know. We don't know for sure. All we can do is just, plot things out in advance and be prepared for them if they play out, and know when to invalidate it if we're wrong. So Dow Jones. So this to me is our first retest, which we've been expecting. This is no big surprise. This is our retest at 200 exponential and simple. We know that what happens when we transition from a bull market to a bear market. We know we break down. Let's look at our previous one, and we can use that as an example. We know we break down, and then we come back up, retest, and then we get rejected. That's just our reversion to the mean, and then we go much lower. But at that point in time, 200 exponential and simple are in a bear market, and the 8 and 21 are crossed to the downside. So that's what we're paying attention to. We want to start getting back in when the 8 and 21 cross back to the upside, potentially for a scalp, possibly for, an uptrend. But we really can't confirm that we're back in an uptrend until right around this level when the 200 exponential and simple both have blue slope again. And there might be some sketchy spots along the way like this. Even this one right here could have psyched some people out or whatever. But we know that at that point in time, we're expecting the 200 exponential and simple to hold. So when they're starting to flip back to the upside and we're coming back down to them, that's our reversion to the mean, and we're buying the dip, and then eventually, we're just ripping to the upside. And the same way, we're still buying the dip right here because it's bullish, still buying the dip right here because it's bullish, and then we're putting in lower highs, and then we're starting to confirm bearish. So now the opposite's going to happen. Now that we're confirming bearish, we're retesting right here, so we want to sell the rip, because now we're confirming into a bear market. We want to be selling that resistance. Now, if this 821 crosses back to the upside, we move back up here above the 200 exponential and simple. We start flipping them back to the upside. Slope looks good. I mean, we're going to trust it. We're going to trust the momentum. We're going to trust the indicators. We're going to trust the charts, and we will assume that the bull market will continue and something change. But right now, we're selling the rip because we're trading with the trend. So while we may have a face ripper bull market rally that takes us up as high as 34,399 or 30, let's say 5,000, we know that that is ideally going to be a selling area. So we're inside this descending channel right here. So our target to the upside is actually a little higher than it is. It's somewhere in between the 200 exponential, the 200 simple, and the resistance line here in green, which also kind of lines up with the top of the channel right there. So we're looking for something around that for a temporary top in the Dow Jones, which, if you bought the bottom of the channel right here and you rode it up to the top, that's like 5.9%. It's not bad, right? But is that enough to get out of bed for? Let's be real here. We don't really scalp in and out of these indexes the same way as we do with like cryptos or like specific like stocks or something like that. This is more what we're looking for as a trend investment. So we're looking to get in at this confirmation of the bull trend right here and then get out at the confirmation of the bear trend right here. And obviously you guys know it's not financial advice. So, and you know what? I want to look at this weekly and remember what we're paying attention to right here. This was the move we were talking about where we break down the 8 and 21 and we get a retest of the 8 and we need to close back above the 8, back above the 21, and then we can start looking about turning this back into a bull trend. But right now it literally just looks like a retest and probably a rejection. And we know it's Wednesday, so who knows what the next 2 days are going to look like. This might end up being just a big old wick all the way up to the 8 and then a rejection on the weekly. But we know that this is still very bearish on the weekly. And then when we look at the monthly, we know this is just that reflex rally bounce off of the 21. And right now we're getting rejected at the 8. We know we have a hard sell leaving the bullish control zone, hard sell leaving the bullish control zone, hard sell leaving the bullish control zone. Every time we have done that, we went into a pretty aggressive sell-off. So is it possible that we rally this and we save it and we go back to the upside? Sure, it's possible. But we have 3 monthly red histograms in a row and we lost the slope line. We're still above it. But everything else is telling us there's a high likelihood that we're going to break down and probably end up close to like 29,000 on the Dow Jones. And that's just our initial target. Maybe we don't get there. Maybe we overshoot it. We'll play that by ear. So S&P looks very much the same. We don't need to go into like super detail here, but it's basically confirming into a bear market. This little pushback up kind of flipped the 200 simple back to the upside. But again, we're looking at resistance at like 438 or 446 on the SPY. IXIC, the NASDAQ composite. We hit the measured move. The majority of the measured move to the downside. Kind of like did a little double bottom here. We know we had that bullish divergence kind of showing its way. We reclaimed that key level here in green. We're back above the 8 and 21 trying to confirm it back to the upside. But we know, same thing. We know that we're looking to either be scalping a quick trade to the upside right here, or we're looking to basically be selling the rip. So it's like a last chance. They call it the LPSY in like a Wyckoff distribution pattern. And it stands for, LPSY stands for last point of supply. And what that means is that we're breaking down from a key level, we're pushing back up, and each time we're putting in lower highs. And then that's like the last point of supply that you can sell into, the last set of buyers you can sell into, and then after that you go much lower. And that's like a technical breakdown from a distribution pattern. And you technically have like multiple levels of it. And that's sort of like the top of our slinky as we're like rolling down the stairs or stepping down the stairs. So we're looking for basically a top in the NASDAQ somewhere around like that 14,143. And then the old Ruddy, finding support at the 236. Still never got a decent test back up to 200 exponential and simple. We had basically a potential bottoming pattern here, but failed to break out on the technical breakout. So we still have essentially, potential for that retest of the 236 or of the 200 exponential, which basically is going to be the bottom retest of that channel. So we broke down from the channel, found support, couldn't get up to it, came back down here again, couldn't get up to it, came back down here again, and now maybe this time we get up to it. So the target to the upside is 2132. Now we don't have to get there. We might just break down from here and go down to the 382. I think more likely than not, we do eventually get a test up here and then break down, but I would not be surprised in the least bit if we just rolled over here. I didn't see anything bullish that happened today. I didn't hear anything bullish. I think sometimes the market is bullish because they're like, oh, it's only 25 basis points. This is good. And then it kind of sets in and it's like, oh shit, there's like actually nothing good about this. So XLE energy, obviously, oil and everything going on is starting to look like a little bit of a top. We're seeing some of the speculative, fervor kind of coming out of this. Now remember, everybody was getting bullish at energy at the absolute top. We have an indecision candle here, and it looks like it's rolling over. We have a hard sell. We have multiple red histograms. Didn't quite print bearish divergence on this, but everything else pointing to the downside for now. For now. Still like energy long term, but it's definitely overdue for a retrace. Transportation sector had a nice little push up right here. Starting to look like a breakout. We do have to be cautious though, because we have this point right here, which was basically a failed breakout. But it is possible that we get a measure move and shoot back to the upside here. Again, we had some bullish divergence printing. We discussed it. We talked about it multiple times. We have a pretty big knife stab right here in line with the bullish divergence. Again, though, I'm not looking to play these short little trades for a couple of percent in what I presume is just the very beginning of, a long-term bear market. So, but we'll see what happens. We could obviously get as high as 92. I mean, we could go crazy and get up to 97. I don't think it happens. I think there's a lot better places to be, but it definitely could. XLF Financial had a nice little move up here. I mean, everything there was a lot of like nice bear market rallies, nice little pushes up here. A retest of a 200 exponential and simple. Gap up to reclaim the 200 exponential. Retest the 200 simple. If we start closing back up above here again, we cross 821 back to the upside, flip these back over blue, maybe it starts looking good again and starts running. There's definitely a possibility. But we've already talked about how this is not good for financials. Everyone thinks that what's happening right now is good for financials because they're like, oh, the Fed funds rate goes up, therefore they raise rates, therefore they make more money. But we know that these financial institutions make their money two ways. They make their money two ways, with spreads and speculation. So they're either speculating on, stocks or whatever to make money, which is obviously, if we're going into a bear market, that's not good. And we know that likely if the rates go up, we do go into a bear market, at least short term. And then we know the other way that they make money is spreads. They loan people money for a spread. But we know that when we actually calculate a spread, if you're getting money for free and you're making a 2% spread on that, you're charging 2% interest on that loan and you're getting it for zero, basically. Just hypothetically. You're making 2% and that's straight to the house. But we know that if the Fed funds rate, let's say, is at 2% and you're still making a 2% spread, we know that your actual percentage on what you're paying for it versus what you're getting for it is much less, because now you're paying 2% interest, but you're making 4% interest, but you're getting a real rate of 2. So you're still getting 2, but the risk has gone up exponentially more because the rates, the cost of money, and the likelihood of a strong economy at higher rate percentages is much less likely. We know that because every time the rates go up, the economy crashes. So they're less likely to land as rates go up because they're still going to make the same spread, but the spread in relationship to the risk or to what they're paying for that money is much lower. So if they're paying more money for it, even if they're still making that same spread, it's more risky because the likelihood of someone defaulting or the asset that they're loaning against is exponentially like higher, that asset loses value or somebody defaults on it. So the last thing they want is their collateral to not be worth the value of the loan, because that's what happened previously, during like the financial crisis or housing bust, etc. So we know that this is actually not good for financials. So I can't see a world where financials do better. Like the best case scenario for the financials is that we actually go back into a bull market, reconfirm, and then the markets start going back to the moon, because that's where they're really making their money. It's not on loans. I mean, they make some money on loans for sure. Car loans or from credit card spreads or from, mortgages or whatever. But I mean, what are mortgages? How many people are going to refinance their house after the lowest historical rates in history, where people refinance at 2.5%, 3%? Nobody. There's nobody left. We saw them falling off a cliff before the rates were even going back up. XLC communication looks like total trash. We hit our target finally perfectly to the downside here. So we're just bouncing our next Fibonacci level, the 382. We know that obviously we have some various like parabolic resistances in play. You could argue that we should put a third one in here, and I would not argue against it. And that we're actually like close to, or that one little outlier makes it tough. But I mean, we could argue something like this, and then we're going to get a pushback up to like the 68 level. It's not like super clean though. I don't love it. But like an 821 cross back here would look good. We could easily have that retest of the 236 we talked about. which would be maybe like an 8% move. Not bad, not great, uh, but again, very bearish. Like definitely one of the more bearish sectors right now. XLP, consumer staples. We know we like this long term. We got that perfect retest. I mean, you can't beat that, right? We retested the top of the channel that we broke out. It held that support for right now. We were able to get back on top of 200 exponential and simple. So now what we're looking for is this to come back up here, put in another lower high, and then roll over, because we know that that's basically just, the beginning of a bear market. So we have basically a resistance here. If we come all the way back up to it, and then we roll over again, cross 821, bounce to 200 exponential and simple, but put in a lower high, it's going to look like it's going to come back down to this level again. And the more times we retest the 200 exponential and simple, the more likely we are to roll over. When we come down to it like this, come down to it again like a double top, and then we put in a new high, that looks good. But when we come back down to it again, and then we break through it, that looks bad. So if we do a similar situation like this where we retest it a second time and then we go to a new high, that's going to look great. And we probably do see continuation. But, realistically, we're probably going to see a little more pressure on this. Short term, it probably does get a nice little pop to the upside, but we're probably going to see a little more pressure on this. But overall, I like this sector for a potential recession, depression. I mean, and if you didn't catch the video where I talked about how to protect yourself in a recession, depression, highly recommend that one, because that is basically me laying out my game plan, and where I want to be. I want to be in utilities. I want to be in consumer, staples. I want to be in real estate. I want to be in, things that pay me to own them, whatever it is. You could stake cryptocurrency if you want. I would recommend, probably if we're in a bear market, a trustworthy stable coin over a speculative crypto, because you don't want to make 10% and then your principal goes down by 50% because we go into a bear market. But so XLU, so obviously utilities, we just talked about that, holding strong above our yellow support right here. Definitely getting a little bit tired though, but overall very bullish on this. Do expect further upside in time. XLRE, if you do want to, speculate on real estate without actually buying real estate, I do recommend that I don't recommend, but for me, my opinion is that I don't want anything to do with commercial real estate. So if it's for business, I don't want nothing to do with it, because I think we're in for a reckoning, because there's basically a change in, people don't want to go back to work. And if they do go back to work, they want to work from home, or they want to work at the office a couple days a week, or they want to live in the country and work remotely. They don't want to be in an office. They don't want to be in a commercial location. There's a lot of young people and old people that are still scared as hell of the Rona, and are like, well, let's just wait 1, 2, 3, 5 years from now. If everything's okay and we're all safe, then I will consider going back to work. But right now, I just can't risk it. I got a family. I got kids at home. I got a mother, a father. I don't want to bring it back to them. I mean, this is how people are thinking right now. These people have been brainwashed for the last couple of years to be afraid of their own shadow. So I don't think commercial real estate's going to go back to the same thing. I don't think some of these people are coming back to workforce anytime soon. And by the time they are ready to come back to the workforce, I don't think the workforce is there waiting for them. But, I mean, we'll see. So commercial real estate, no. Houses, people need to live somewhere. Or, you can own a house. The value of the house can fluctuate up and down. But if it's paying you the whole time to own it, or, it's basically paying your mortgage. So even if you're just breaking even after everything to own it, at least you're essentially paying down a debt through someone else, like borrowing your asset. And that's, similar to like staking type deal. All right, so VWO, Vanguard, emerging market ETF. So obviously, China had a massive pop to the upside. Now we have to be careful. This emerging market ETF has a large chunk of China in it. Now this is what we were talking about here: a potential breakdown and then retest or reclaiming that level. Now it looked like it was going to roll over, but obviously quite a bit of damage had already been done. So this should make us bullish, right? Because we reclaim that level. Well, here's the thing about what's going on in China right now. They basically came out and said, hey, we don't want to like wreck our investments. Like, we're already like going to start easing again. We're not going to be as hostile towards investors, foreign investment, speculators, etc. We want a good stock market, a good economy, a good everything. And then they actually started like buying in the market. which is not good. I mean, short term it's good, sure. A lot of stuff had like a 20%, 25%, 30% pop, but easily we could see different countries, different exchanges delisting Chinese stocks because it's basically like market manipulation. You can't have a government buying publicly traded companies openly in these markets. I mean, you can because nobody gives a shit. I mean, SEC doesn't give a shit. No one gives a shit. Who cares as long as they go up, right? But I mean, for me, if there's one thing I've learned over time, it's that when you start trying to control what's supposed to be a free market, eventually it fucks up. Something breaks, and when it breaks real bad. So to openly admit that they're basically like manipulating the market, to try to like recover or whatever, it doesn't look good to me. So is this a face ripper, a bear market rally? Is this sustainable? I mean, I don't know. We'll see. But to me, it looks like a sucker's rally. Doesn't give you enough time to get in it. And then next thing you know, you get wrecked. And the risk reward is like ridiculous. So, I mean, it is what it is. But we always talk about it, on the way up, take the stairs. On the way down, you take the elevator. And then in a bear market, on the way down, you take the stairs, and then elevator. So what happens after that? Probably just more stairs down. So, but we can still have a little more move to the upside. We see the VIX was getting tired. We were expecting some kind of pop. Some of this was a little more aggressive than what I was expecting for sure. I wasn't expecting China to shoot to the upside. I mean, we know that there was a lot of fear in that trade, and that there's a lot of uncertainty. And then they had like more lockdowns, and they're like having Rona breakout. But what did we say in the last stream? We were like, I mean, really? China's like locking down again over like Optimus Prime like variant? Like, get the fuck out of here. I mean, it's like nothing now, right? I mean, I don't know. Maybe I'm just over it. I've had the Rona a couple times. I'm still not dead, so I figure until there's a worse strain, I'm not going to be more worried about the less severe strain that's more transmissible. I don't know. I mean, we'll see. We'll see. DAX, so Germany, obviously we see all these things had a nice pop. So the DAX, again, we talked about this specifically. We have this long-term trend line in green right here, and we poked out the bottom a couple times, and each time it recovered except for this one big one. So we did the same thing. We had a bunch of green histograms, hard buy signal. We reclaimed this area, and then we had a nice pop back up. But now we need to pay attention to, do we get wrecked here or rejected here and then come back down rather? I mean, we just have to wait and see. Obviously, it's a bear market. When we start looking at the longer time frames, though, that's when we can start getting a better idea of what's really happening. Okay, we confirmed back into a bull market after kind of going sideways for a while. We're in a bear market. We came back up. This is our retest of the confirmation. So we just confirmed into a bear market by flipping the slope right here on the weekly. This is our retest, our reversion to the mean. And then what likely happens? What likely gets sold into? Whoever got trapped in this candle right here, an institution or, whatever, a bank, institution, whale, government, whoever was speculating that got trapped in this dump right here, probably just pushed the price back up so that they could exit, at break even or somewhere closer to it, the reversion of the mean play, and then we'll see the continuation of the downside. Doesn't have to happen, but that's what it looks like to me. Looks likely to me. But overall, we're just now confirming into a bear market on a weekly, so maybe that was the bottom, but maybe we see continuation. So CN50, obviously China, that was our big bump up right here. And then now it's starting to give back some. I mean, and this is such a massive candle right here. It's like, I mean, what do? Do you short into this? Do you buy the dip? There's no good play to be had right here, If you're going to try to catch the knife, you got to just do it and take the plunge and get stopped out or get rewarded. You got to be real careful buying into, a bull market reflex rally like that, especially a real aggressive 20-30% one. UK 100 again had a nice move, reclaimed 200 exponential and simple, consolidates here long enough, it starts looking bullish again. Bunch of green histograms, hard buy signal, actually looks okay. Reclaimed a key horizontal support. Brazil, I've got a couple request ones in here too, so I'll try to spend a little more time on them. So this is EWZ, which is basically just Brazil ETF. Now, part of the reason I like Brazil, and I've mentioned a couple times, is because they're so commodity heavy. They have like a lot of exports, coffee, all kinds of like good stuff. So, if you were going to speculate on an emerging market, I don't think Brazil would necessarily be a bad one, especially since it's, let me go to a longer time frame. Especially since it's basically peaked out back in 2008. We know it was in 2008, obviously. The time before that was 2000, and then had a nice retracement, and it's basically been in a perpetual downtrend. And now it's essentially retested 200 exponential and simple, and now we're potentially putting in a higher low, looking to come back up here. So next target would be a retest of the 38 to the upside, and then after that, 47, which is going to be a very hard resistance right here because we have topped there multiple times in the past. But if we just throw up a little fib, we can do it either way. We'll do an internal retracement from the top to our bottom right here. And then we can see we're basically topping out at the 382, trading very technically. We bottom right here. We top out at the 0.5. We come back down, lower, basically double top right here. Come all the way down, find some support. Retest 236, 236. We're back at the 382. So next target would be a retest again of the 0.5. And then after that, we would expect a nice clean tag of the 618, possibly even, we could top out at the, 200 simple, but I would think if we come back up, we'll hit the 618. So I would think around like 51.37, something like that, which is a nice little 50% move. Now, granted, we could still have a little more downside potential on shorter time frames. Weekly looks okay, looks fairly decent. Obviously at resistance, probably going to have an opportunity. I mean, realistically, what's happening? We're just putting in higher lows right now and smacking our head on the 200 exponential and simple, and then eventually we should break out. So, I think long term, if we were looking for something like this, it's not a bad place to enter somewhere down in this range, preferably a little lower. We'll see what happens. If it holds right here and starts consolidating long enough, and then on the daily we break above like 34 and start flipping the slope back over, I'll just go ahead and up the ante on this one a little bit, because at that point in time we're looking at like 41. But right now, you guys know we're right smack dab in the middle of two fibs. So it's basically a coin toss. Does it go up first or down first? So I don't like to buy right at like the central location. I'd rather buy support and sell resistance. But realistically, the next target's going to be to the upside. Theoretically, if we continue the micro trend to like 51. So 42, then 51. That's what I'd be looking for. But it does look like on the shorter time frames we're losing momentum. So I really would want to see this come back down a little bit further, or at least hold and consolidate here a little longer until it basically like flattens out the 200 simple, and then we could essentially flip back to a bull trend. All right, so let me jump in chat real quick, and then we'll keep on ripping. All right, let me scroll back up here. I don't know where I left off. Peter Gerd says, yes, Trading in the Zone is Mark. Yeah, I can't remember. I think it was that book, though. Mark Douglas. Quinn Rivers. It might have been the other one. I can't think. I can never think of names of books or people on the spot. Quinn Rivers. Yeah, I appreciate you, brother. Thank you for the kind emojis. Crypto Galt says, mate, RE14, who care? Your analysis, absolute gold, and is cornerstone of my week. Thank you for your intelligent knowledge and generous commitment. Walking the walk, bro. Walking the walk. Hey, appreciate you, brother. Thank you again for the kind words and emojis, my friends. Best community for sure. I mean, might not be the biggest, but it's definitely the best. Hunkiness says, hey, guy, did you talk about Saudi Arabia selling oil in yuan? Is this a huge thing? No, I mean, I don't think so. You think other countries haven't been, dealing in alternate currencies to the dollar? Whether it's crypto, whether it's yuan, whether it's XYZ currency to skirt sanctions, or, just backroom deals? Yeah, right. Yeah, right. I mean, long term, 5 years, 10 years from now, does it make a difference? Yeah, I don't think the dollar lasts long term. I definitely don't. But, I mean, if we look at the dollar chart, I mean, it doesn't look scared. I'll tell you that much. It's like the most bullish it's been in a long, long time. I mean, but long term, yeah. I mean, I think the dollar goes away as world reserve currency. Historically speaking, of course it does. Every time. I mean, like Roman Empire, Great Britain, United States, they'll all be like essentially a reserve currency that eventually is no longer that. Lazy Boy says, the trouble with China is they don't have a Western-style health service. Also, most of them live very unhealthy. Smoke, etc. Hunkiness, I think China looking down could be just to F with us. Supply chain. Oh, locking down. Yeah. I mean, look, there's probably something to it. I mean, let's be real. Is it a complete conspiracy theory to think that China and Russia might be doing things intentionally to take advantage of current situations? I don't think it's conspiracy theory. I think that they're both their leaders are intelligent and know that they possess quite a bit of power based on what's going on right now. But realistically, China needs the world as much as the world needs China. And, same with Russia to some degree. I mean, where Russia's economy, Russia will go to complete shit if they can't sell any of their, food or oil. So then I guess what? They just sell it all to China, and then China and Russia, and Saudi Arabia, like, start creating their own little, Eastern thing, and then it's the East versus the West. I mean, I could see it happening over time, but it doesn't happen quickly, because we talk about this all the time. In order to transition off of the dollar as world reserve currency, first you have to like settle all your debts that are denominated in dollars. So if we know like over like 50% of the world's debt is denominated in dollars, and it's not like you can just be like, fuck you, USA, we're not going to pay you. Well, you don't owe the money to the USA because it's denominated in dollars. Like there's tons and tons of Chinese debt, Japanese debt, all over the world. There's debt denominated in dollars that's owed to that same country. It's just denominated in dollars instead of in that country's currency. So in order to settle out a debt, if I borrow a gallon of gas from you and then gas goes up to $10 tomorrow and I go, here's $5 for that gas I, borrowed from you. And I'm like, yeah, right, dude. Gas is $10 now. I want a gallon of gas or enough money to go buy a gallon of gas. And you're like, yeah, but it was only $5 when I borrowed it. Well, you're shit out of luck. You borrowed a gallon of gas, so you owe me back a gallon of gas or enough money to go buy a gallon of gas. It doesn't matter what you borrowed it at. So that's where the speculation comes from. When you speculate outside of your own currency, that you have to actually pay back in the currency you speculated in or the good that you borrowed, etc. Same with like shorting a stock or something like that. So that's why a lot of times people will denominate debt in dollars in other countries because the dollar's been in a perpetual downtrend for the last, 40 years. So people are like, oh, I'll just borrow $1 from you and then I'll pay them back to you in the future because they'll be worth less. So I win twice because I get to borrow money from you in the meantime to do whatever with. And then by the time I pay you back, the dollars will cost me less of whatever goods or services I'm generating them in. But when you speculate that like that in a non-denomination currency that you're like paid in, you basically take like foreign exchange risk, which is why I've been saying that the dollar needs to actually weaken or it's going to completely screw over the world. The dollar people have been so bearish on the dollar for so long, and now it's going to completely screw over the world if it doesn't come back down at least a little bit and consolidate. That's what I was saying with the pullback right here. Think about how many people are trapped upside down in a dollar position. You take out a loan in dollars and it's not your world, your currency where you live at. You're getting screwed here. Your loan went up by 10% in the last couple months. And then if you're like super bearish on the dollar and you took out some kind of long-term loans on the dollar or whatever, back in March of 2011, it was at 73. Remember not that long ago when it was like breaking down right here, everybody was talking about how, literally everyone was talking about when we were down here at the bottom, and I was calling out the bottom, the double bottom, the higher low, the retest of 200 exponential and simple on the monthly. I was extremely bullish on the dollar right here. Everyone else, but maybe like 2 people that I ever heard speak about the dollar, the DXY, the world reserve currency, whatever. Everyone was bearish. Everyone was convinced we were going lower. Look back at that time frame, right around that time in, December 2020, somewhere around then. Look back at everybody's content, everybody that was putting stuff out that didn't delete it because they look like a fucking moron now. They were talking about, oh, you just wait we're headed back down to 85. And then when we get to 85, we're going to 72. And then when the dollar goes below 71, that's going to be a new low. And it's just going to crash down to zero and lose world reserve currency status. I mean, literally everyone was saying that. Everyone was saying that when we were right here. Everyone was convinced we were going lower. And now where are we at? Well, we're threatening the multi-year high right here, and it sure does look like an uptrend to me. I mean, we got a monthly 200 exponential above the 200 simple. We're above the 8 and the 21. We're retesting a key resistance here, and then after that, we have this resistance, and then after that, we just have a series of higher highs and higher lows. And again, it's the same thing. You know, this chart's obviously insane, but just don't focus on that. Focus on this yellow descending line right here, and you know that my target for the dollar is all the way up here at like 110. So if the dollar goes up by another like 10, 12%, and a lot of people are already sweating, you know, long-term debt from say 10, 12 years ago that's upside down, you know, already by like 15, 20%. What's that going to look like, you know, when we burst over here to the upside? And it just so happens we're retesting the 0.5, you know, right now. And the next target, if we just shot up right now and went up to the next target, it would be 106. If we take our sweet ass time to get there, and eventually we get to my level, closer to like 110 up here. And then obviously, you know, the white fib becomes validated. And then also, you guys know I have like the time cycle analysis in place here for our various peaks. And that would correspond with our yellow peak here. So we'll see what happens. I mean, maybe I'll be wrong. And then everybody else will be right. But so far, I like my odds. But I'm dead serious. Take a look at and obviously this looks like we're topping. Lower high, hard sell, short term. We want to see this come down. We don't want the dollar to just go absolutely parabolic because that's really, really bad for like the whole world. I mean, it's good if you live in the United States and you don't give a shit about other countries and commerce, but that's not good. It's not good for the world. So we want to see this kind of cool back off and some of these positions, you know, bearish positions against the dollar unwind a little bit. Tesla next. Tesla retested 200 exponential and simple. Still looks pretty damn bearish to me. Now we did have, you know, basically a couple drives of bullish divergence. Came back up, and you know, now we're getting that push up here to try to reclaim the 200 exponential and simple. Does it reclaim it? I don't know. It doesn't look particularly amazing. I mean, it's not looking like a technical breakout or anything yet, but we obviously have some kind of like resistance trend line right here. And if we clear back above this 821, 200 exponential and simple, we probably retest the 896 level, 900 or 947, which is basically like our top resistance here. But you know, this looks like some serious distribution taking place to me. And longer time frames, it doesn't look good. You know, retest the 200 exponential and simple. Looks like we're ready to roll over. And then this is what everybody is super excited about. This is Alibaba. So obviously Alibaba had a massive move today, 36%. That's awesome. That's obviously awesome. 36% in like 2 days is absolutely phenomenal. I mean, you can't beat that, right? So now, instead of being down 77% from the all-time high of October 2020, instead of being down 77%, now Alibaba's only down 67%. So that's great, right? That's super, super bullish. I mean, or it's still just equally bearish. It just had a, you know, 30% move to the upside or got back 10% of the losses. Does not look good to me still. Nothing has changed as far as I'm concerned. This looks like the retest of that support. You know, did I expect it to just happen this aggressively? You know, did I expect it to front run the 886? Did I expect an immediate move back up to the 618? I mean, no, we can't expect anything, but you know, we basically targeted 886 for downside and then expect to retest as we continue to break down. It's not going to be a straight line. We know that. But obviously that was a very aggressive move to the upside. Very aggressive move. I mean, a lot of shorts, especially if you're late to the party, probably not loving life right now. Baidu, same thing. You know, it had a nice move back to the upside. Had an aggressive move back up here. What was it? 30-something%? 39%. Again, very nice move to the upside from some pretty painful levels. Basically bounced the in between 786 and 886 all the way back up to the 618 and our key heart line of this, you know, massive channel we've been in. But again, what is this really though? It's just a retest of the breakdown, still down substantially off the highs. So people see like 30% and they're like, oh, it's back, it's back. Still down 57%. Still in a clear bear market. Definitely not worth getting excited about. And when we start to look at the longer time frames on these things, is when you realize all we're doing is just retesting key levels before what I would assume is going to be continuation of the downside. Still looks very bearish to me long term. Now, is it possible the bottom is in? Sure, definitely. It's definitely possible the bottom is in. Bears are fully in control. This looks like a monthly attempt to reject lower prices before the histogram crosses below the slope line. We see obviously a couple times where we saw a similar move like this, and then we got a nice move to the upside. Definitely possible we see that. Definitely possible we see that. But I mean, a lot of this is probably short covering forced by the Chinese government stepping in and buying. So NEO again came down here to new lows, all the way back up. I mean, another like 40% move, something like that, 25% move in a day. Nice little gap up. Left a lot of gaps down below though, so likely comes back to close them. We see ARKK, even Kathy Wood made 10%. I mean, so she's crushing. Obviously doing phenomenal. So she's only down 62%. That's pretty good, Kathy. Congratulations on your massive move today. We were talking about basically some support levels through this range. Again, I mean, these things aren't just going to melt down forever. But as far as I'm concerned, it still looks horrible. It looks almost as horrible as all these drawing tools all over this thing. I mean, we still have to like break through some kind of like downward descending resistance line. I would think it probably pushes up here and retests the 382 before continuation. We obviously saw a lot of these things printing some bullish divergence short term. SMH, semiconductors, had a nice move to the upside. This looks like we're going to get that retested 200 exponential and simple, probably between like 269 and 275. Again, printing some nice bullish divergence. NVIDIA, again, nice move, trying to save the 200 exponential and simple. Pretty aggressive move. Definitely have like our resistance line here, so we're at the top of the channel. If and when we get the breakout of the channel, we know we have the measured move from the bottom to the top. So let's just say tomorrow we break out of the channel, consolidate, and we get our potential measure move. Target would be like 321 from 244. So that would be a nice move right there. Netflix, basically retesting our breakdown resistance right here. Again, putting in some decent little bullish divergence, trying to see some kind of bounce here. I think a lot of this is reflex rally off the Fed because people are like, oh, that's bullish. It only was a quarter rate point hike. But like long term, when you think about it, you're like, well, that's not good in any way. I don't see a world where that's a good situation. I think the best situation would have been if they hiked 50 basis points, the market felt a little pain, and then afterwards was like, okay, at least they're trying to get things under control. But we know that inflation will directly affect consumers' buying power, and that will directly affect, the bottom line of these companies, either through sales target misses or revenue target misses or profit margin or all those things. So if the consumer is weak, which we know they are, the consumer is weak, that's not good for these businesses. So we want inflation to come down. So we want the Fed rate to go up to fight the inflation so the consumer can get back on their feet. But that's obviously not what's happening. Apple looks like it could bounce back up here to the top of the range as high as like 166 or so. Again, I'm not getting overly bullish on these things though. Also not getting overly bearish on them either. Microsoft has the retest of 200 exponential and simple. Still just kind of operating inside this right shoulder. Just consistently putting in lower highs. Now, if this starts to threaten 303 or 305, then we can start paying attention. He said, lazy boy said arc to the moon. China, the stocks looking like crypto. You mean manipulated, or are you talking about the aggressiveness of the bounce? Because it might be both. Amazon, nice little breakout of our descending resistance. And again, just kind of saving the bottom here. Very clear bullish divergence once again. Hard buy signal. I think we could probably push back up and get that reversion of the mean play. potentially as high as like 3,200. You know, I still see all these things going lower, honestly. I mean, I really don't think this is like the bottom being in. It's like, oh, look, we came back down and we retested 200 exponential and simple, and now we're going to break right back out of the bear market and we're just going to go bullish again. I don't see it. I really just don't see it. I think this is like the death throes of a market, you know, and the attempt to just close positions and, you know, sort of like admit defeat, exit positions, and then just sit on the sideline waiting for opportunity. You know, knowing that we're probably going lower. So Google, Alphabet, retest of the exact level, you know, the 2674 level, retest of the 200 exponential. Going to try to come up here, reclaim the 200 simple. You know, same thing though. Probably just rolls back over for a lower high and then eventually comes back down to the 236. You know, I mean, maybe we'll be wrong though. Maybe these things will all just burst back up. We'll start going to new all-time highs again. Not opposed to that. My life would be a lot easier if everything just went bullish again and we could just fully speculate and go back into a parabolic uptrend. I'm not going to lie. That would be absolutely great. I would not be mad whatsoever. Now, does that seem likely? I don't think so. Let's rip through these, then we'll do crypto. And I'm already running way over 211. Yeah. All right. So let's do these quick. So gold, blow off top, as we discussed. You know, once we bearishly engulf that candle, it looked real bad. But this is why we were saying, let's just wait for a technical breakout and a new all-time high. Because now, look, anybody that FOMO'd in the last, you know, $100 worth of gold, $150 worth of gold's movement is now down like 10%. So not cool. We did come back down to the technical area we discussed. Could come down even slightly lower. Maybe even come down lower than that. We don't know. But realistically, you know, what we're looking out for now is something like this to happen. Now, I hypothetically drew in the bottom of this channel, but you remember what we were talking about. We're basically talking about something like this, where we get a descending channel. Now, we don't have enough points to even begin to plot it. But just as an example, what we're looking for is that cup and handle pattern to actually play out right here. So what we want to see happen long term, God, I always do this wrong every single time. Always do it the opposite way I meant to. We're looking for this cup and handle to basically happen, where this essentially rounds out into, you know, our cup shape, and then the handle forms as a descending channel. And then I'm going to extend this out. This is just basically the fib from the high to the low, but we can use it from the low to the high because it came to the exact same level. Just reverse the numbers on the fib. But we want to see this come back down to like the 0.5, kind of bounce this channel, maybe even to the 618, or in this case on the chart it says 382, but retest that descending resistance line. So we want to see it do something like, you know, and this is ideal situation for gold to be bullish and it to just do exactly what we think, you know, and just act like our bitch. It doesn't have to do that, but that's if it did what I think it's going to do, and it just acted like our bitch. It does something like this. It just goes like this, then it comes back down like right here, kind of chops around, bounces back up, chops around, technical breakout to the upside, and then at that point in time, we complete the cup, we complete the handle, and then we get the measure move breakout of the cup and handle, which would basically be a measure move from the bottom of the pattern to the top of the pattern to the upside from the neckline, or in this case, the rim of the cup, which would roughly take us to, you know, and this is all hypothetical, just me messing around, drawing stuff on the chart. Obviously, none of this would ever happen. But that would put us at $2,600 gold. Now we have the 1.618 target at 23.64. We have the 2.618 target at 29.36. So that's the areas we're paying attention to. And then, you know, obviously we have some key levels along the way that we would watch, but something like that would not surprise me. But yeah, so that's basically what we're paying attention to on gold. So looking for more opportunities to add to our gold position as it kind of chops around in here. Or maybe we get a technical breakout and it doesn't do that. And it's not a cup and handle and we're wrong. But I suspect it is, because gold's like notorious for its cup and handles. Matter of fact, there's a gigantic one on the macro from like our 2011 top that we already like broke out from. So, So silver broke back down below the heart line, failed to hold this as support. Now it's kind of acting as resistance. The 200 exponential is crossing above the 200 simple. So we really just want to see this chop around for a bit, confirm the 200 simple back bullish, and then, basically have like a bullish reset and then see continuation. We didn't even get nearly up to, I was hoping this would get at least up to like 28, 29, $30. Obviously, gold has been much more bullish than silver, but hopefully it will have its day. Gold-silver ratio on the weekly definitely looks like the 821 is going to cross down. So it looks like basically a double top, like gold is going to lose strength compared to silver going into the future. That's what it looks like for now. Which is good for a bull market technically, because that's usually what we see. THCX, pathetic bounce on weed stocks. They had like a little 5-10% today. Would not be surprised to see them go lower. I've been looking to build more of a position in them, and I just don't see any life out of them lately. But, I'm still very bullish on them sometime in the future. But, let's be real. Most of these big company plot stocks or indexes or whatever, if I put, some money into them right now and then said, do I think they're going to be higher or lower 1 year from now, 3 years from now, 5 years from now, 10 years from now? I would say 1 year from now could go either way. 3 years from now, there's probably at least a 75% chance that they're higher. 5 years from now, 85% chance. 10 years from now, I would say there's like a 95% chance that they are higher than they're at right now, or you just picked a really bad one and it doesn't exist. So, and that's where like the indexes, THCX or YOLO or something like that come in, But chances are, if it doesn't exist, it probably got bought out anyway. So you'd probably still be okay. Or I would. CCJ Cameco had a pretty nice breakout right here. Basically had the measure move of the breakout of the channel right here. I probably pretty close to the T. Yeah, almost perfectly. Literally like exactly perfectly. Kind of topped out, which just happened to be, sorry about that. Which happened to just be like, basically another double top right here. So we'll see what happens if it rolls over here. Energy, uranium, a lot of these things, commodities in general, I think are probably going to roll over at least short term. The energy trade or commodity trade in general got pretty played out. The stock market short got pretty played out. The China short got pretty played out. Tech is pretty beat down. So it's not surprising to see some of these things, having like a little bit of a bear market relief rally. Kind of a reversal on all these things, like short and long term. Dollar's been pretty strong, so I'm not surprised to see it kind of selling off here. This is what we want to see. We don't want to see things going parabolic, because you're either in it and you're just laughing all the way to the bank, or it's basically just running away, and then you're feeling that FOMO. And neither one of those is good. Well, it's good if it goes parabolic and you're already in it, but we really don't want that. We don't want the world's like system and like commodities or stocks to like completely like break down as like a functional way to like speculate. We don't want that. We want, nice controlled bull moves to the upside, not just like parabolic, like, giant green candles or giant red candles. That's not good for like stability of society as it exists. We don't want them to start removing speculative tools that we use to make money because it's too volatile, which, obviously we're seeing from like Barclays with some of these contracts, or like halting trading on nickel. We don't want to see stuff like that. Don't want to see big family offices, corporations, banks blowing up. We do not want to see that. It's not good. So today I pulled up CPER via request instead of the miners. This is just the index. So again, slightly higher high right here. Sort of looks like a double top, but overall looks good. Still very bullish. 200 simple is rolling over, but if we stay above here long enough, 200 exponential is going to cross back on top, and copper likely runs again. So still looks pretty good. Hanging out at the top of the range. Have to be careful though that this isn't a form of Wyckoff distribution or something like that. Really want to see, does this start looking like a basically like a channel right here between the two fibs, where it essentially just like chops around and then goes lower. I'm not going to mess around with redrawing this, so we'll just take that off. You know what I mean. Platinum. Sorry, I'm going to try to speed through this stuff to get to crypto and then call it, because we're like way over time. I went way too long in the beginning, but it was very important, obviously, and we don't have those Fed funds meetings too often. So platinum breaking back down below 200 exponential and simple, technically back in a bear market, flip the 200 exponential back over. 200 simple is still bearish. But as long as we're kind of chopping around this range, it doesn't look bad. I mean, it looks bad still. It looks terrible on longer time frames. But it's looking better now. Was like losing the 200 exponential and simple on the weekly and kind of like bounced it, but it put in another lower high. So we got to really see what happens right here. Does it hold above, consolidate, and then, you know, eventually we get a breakout of the channel and shoots way up to the upside? Or does it break down from here and go much lower? That's what we're paying attention to. And at this point in time, I don't know. I mean, commodities look good to me, but I don't know if that's going to happen. I don't know if we see lower prices first. And then palladium obviously was like super speculative again, had a parabolic run, came all the way back down. And again, just consolidating above the 200 exponential and simple, trying to reclaim those levels after a parabolic move. We would expect now, after a burst to the upside, that we would hold this level, flip them back bullish, and then see continuation. So on the daily, this is probably a decent opportunity. We did put in technically on closes a higher high right here. Obviously, this, don't worry about that little guy right there. Definitely not some weird stuff going on. Definitely not, you know, the reverse nickel candle by any means. On the weekly, though, could it come down lower? Yeah, I mean, it really could. It could come down to like 1,957. Looks pretty bullish. Looks like it's going to roll over. Short term, this probably does see a little more pain, but, you know, I don't know how much lower it goes. And, you know, depending if you're trading paper contracts or like spot markets, whether now is just the time to get in, how the premiums are even going to react. Because typically once metals start moving and looking bullish, you don't get like good premiums after that. Because like the middleman, you know, metal dealers are just going to take advantage of it as long as they can. So as long as there's demand and potential for a bull trend, you know, they're just charging out the wazoo. I mean, obviously, look at silver premiums. Still have not like come down to a reasonable level after, what, a year plus of silver not looking good? We're looking okay, I should say. All right, so Bitcoin futures chart trying to cross the daily back to the upside. Had a nice little move up here. Definitely building a little bit of momentum on the daily. Back above the 8 and 21. Really just want to see this hold that 4,000 level. We did have one false alarm here, two false alarms here. So, you know, another pushback up to 44.3 and failure. Another like 7, 8, 9% move would not seem unrealistic. But it, you know, it's better than selling off. So at this point in time, we're basically just forming, you know, we drew it a while ago. And I think on the last stream or 2 streams ago, we were talking about how we don't short into support. We didn't want to short into support. And now look what happened. We just bounced that same support again, bounce it back up. So now we don't buy at resistance either. So we're in the middle of the range right now. So if we come up here, the resistance is going to be 43.50, somewhere around there, or 43.5, somewhere around there. That's where we want to put in our shorts at, is at resistance, at the 200 exponential, at 200 simple, at the orange resistance, at the yellow, you know, what was support acting as resistance. We want to put in our short-term scalps or longs off of support. But overall, we know this is a bearish pattern. You know, it's a bearish pennant. We have a lead in, bearish. We chop around for a little bit. Distribution takes place. And then we have another lead to the downside. Now, the question is, do we get another push to the upside and the completion of that B higher? Or do we just go lower from here? I don't know. We have to wait and see. But, you know, starting to look better on the daily, at least short term. But that is a perfect example of exactly what we spoke about last time. How we do not want to just short into support. And I mean, I think we discussed it and I even drew it out. And I said, if you short into support and it pops back up to the top of the range, I think it was like a 19%. You know, that's a lot of pain. Yeah, you don't want to be stuck 19% upside down in a short. I would much rather short off of the resistance at the top of the range and take my chances that it just chops around, comes back down, and then I close it again and I buy back down here. You know, I mean, if you did it every time, you know, bought right here, or say you didn't get in on that one, say you didn't get in on this one, but you buy the bottom of the range, sell the top of the range, buy the bottom of the range, sell the top of the range. I mean, just chop around in a little 20% range. You can do okay. But we did find support once again on the TDMACD blue slope line. Still looks okay. Obviously, still very much in a bear market. Would not be unrealistic to think we get a pushback up to 44.5 on spot market. This is that weekly range. We basically bounce that same level again, trying to get another retest, trying to close above the 8, trying to close above 21. If we close above 43,535 on the weekly, it's going to look good. If we close above 40,300, it's going to look okay. hard buy signal. So again, got to be careful of a false alarm, but we know we need to cross above the 821 to look good. First green histogram, that looks decent. Starting to look okay. When we come to the monthly here though, we look and we see exactly what we were expecting basically. A bounce off of the bottom of the range, a move back up to the top of the range, a bounce off the bottom of the range, a move back up to the top of the range. So literally, as far as I'm concerned, on crypto, on Bitcoin, we are literally range bound between 44.5 and 37.5. So that is our range until we break in one direction or the other. We're just range bound. And on the monthly chart, it still looks very bearish. We have weekly and monthly bearish divergence taking place, and it sure looks toppy to me. So, and obviously the daily is bearish too because we're in a very clear bear market. Ethereum still looks pretty bad. We got the retest of the orange trend line. So if we can cross the 821 back to the upside, you know, we had 2 fails and got rejected at the orange trend line. So we either get rejected right here and go back down lower again, or we break out here and we get the retest of 31.5 or 35.20. I took profits on my Ethereum trade on that last push up here. So if we break back out, maybe I will take a scalp back to the upside, but you know, I'm not getting greedy with these things because, you know, they look bearish to me. Bitcoin dominance looks good. We have crossed the 821 on the weekly. We have blue slope line, nice aggressive bullish move on the stochastics, nearly at the top of the range. I do still expect it to get slightly higher, maybe another like percent, and then probably chops around a little bit before a potential breakout. But it looks like Bitcoin is going to gain value in comparison to altcoins, which means we're going to have an aggressive move in Bitcoin and alts lag, or a move to the downside in Bitcoin and alts go down faster. Total market cap on the weekly looks exactly like Bitcoin, just retesting the 8. If it can close back above the 8, we expect it to move to the 21 at like 1.93 trillion. Coming out of the bearish control zone, definitely looks good. First green histogram looks terrible, but the beginning of a potential attempt to carve out a bottom. But again, I expect to go lower. Solana. So we had a little bit of bullish divergence play out here. Looks nice. We have the blue slope line here. Didn't quite get down to our target. Obviously, we had that one wick, but still just never made it down to the bottom. Trying to close back above the 821. If we get an 821 cross on Solana, it's probably going to look good. Probably is already back at like 97, 98 by then. Which I think somewhere around like 103 is resistance, maybe 116, possibly as high as 141. We have officially confirmed into a bear market though. It's hard for me to get bullish on these things, but I would have liked to have got a little scalp off that slightly lower, but it is what it is. So Avalanche trying to reclaim that key 618 level and reclaim the slope here in blue. All these cryptos pretty much look the same. Some are slightly more bullish, some are slightly more bearish. Maybe this comes up to like 89, another like 10, 12% move to the upside. Matic still operating inside that descending wedge at resistance. You know, if it breaks out of this wedge, it very likely goes to 1.65, $1.65. So up another 20 cents, 15%. If it breaks to the downside, I expect it to 382. So again, right smack in the middle of the range in what confirmed a bear market. So I don't know. I would not get too excited about this recent crypto rally. I really wouldn't. If we see Bitcoin closing the 4 hour above the 200 exponential and simple, holding and then crossing them back to the upside, I think we can start looking for some momentum trades, which is basically what's kind of happening right now. And then we can confirm a 4 hour back in a bull market. We still got to be careful because the daily's in a bear market, but that would at least be a potential justifiable entry for like a scalp turn into a maybe positional trade over a longer term. Luna still chopping around at the top of the range, probably one of the stronger cryptos, potentially putting in like a bullish reset right here as it essentially just consolidates and doesn't go lower. We do expect a test to 84. If it breaks down below 84, the 821 probably crossing and it goes much lower. If it can reclaim, 90, it probably goes to new all-time highs or at least retest 104. But definitely the better of the charts we've looked at. And then Theta just hanging out at the heart line of the channel. I mean, basically got like a retest back down at that blue support and then hanging out at the heart line of the channel. So if it goes bearish, it probably comes back down to like $2. If it goes bullish, it probably comes back up to the 236 at 389. And right now it's at 287. So, I mean, coin toss at this point in time. Most of these things are building up daily momentum on the TJD, TDMACD. We have like the blue slope line and it's acting as support. But each time it's getting like smaller and smaller bounces, which likely means it's going to break down. And they're all below the 200. Well, most of them are below the 200 exponential and simple and confirmed in a bear market. So, I'm not going to get overly bearish on these things right now. Now, again, if you want to go down to a shorter time frame and say, okay, this looks really bad on the daily, but, what about on like a 4-hour or something like that? You could look at that as an entry to potentially get into a daily position. So I would say, okay, if we can break above this descending trend line, maybe that starts looking good again. That's a breakdown of that channel or of that pattern. And then maybe we could go to like a 4-hour and look like, all right, if we can get above that, and that just so happens to line up a 200 exponential and simple, consolidate, flip them back over blue, get a confirmed breakout, then we can start looking at like, a breakout with like, potential target as like that previous fib level and some kind of bullish move to the upside of like, 24%, put in a tight little stop. If we break down below 200 exponential and simple, start closing back below them, and it doesn't look like it's going to hold, get back out. But essentially we want to see something, ideally, if we were looking for like a short-term scalp slash potential, oh my gosh, really? Potential trade, we would look for something like this to happen. A breakout, a consolidation, and then that would be the move that we want to capture, with our trade setup. And then if it failed, we would basically be looking at something like this happening, where we break out, come back down, and then it doesn't hold, and then we would want to be stopped out, and then maybe it comes back up, and then we could reevaluate, and it does hold, and then we get the move. But we don't want to just risk this whole trade failing and then being stuck in a position because we were just hoping that it would do what we wanted. Because it could just as easily come back up here, looks bullish, and then you don't enter your stop, and then it breaks back down, chops around, and then goes much lower. So that's how I would look at that scenario. And that's, bullish and bearish case scenario or kind of chop around scenario. But, there's definitely some potential in these things. I hate this tool. I wish it just went away after you used it, like every other tool. So there's definitely some potential there, but we want to wait for it to break out, consolidate, and then take advantage of it. In my opinion, that's what I like to do. But yeah, that's it. We did it. We made it to the end. Yeah, fuck yeah, we're done. Yeah. Hope you guys enjoyed the stream. Fuck J Powell. Woo. All right. Appreciate each and every one of you for tuning in today. Arc to the moon. Hell no. The reverse moon. It might go to the moon by going so low that it comes out the other end of the earth and then it hits the moon. But no, that's hilarious. I'm pulling for Kathy. I think if you're going to bet on one ARC stock going to the moon, it should be the only one that's performing well. I believe it's SARK. But yeah, I'm just messing around. But I do appreciate each and every one of you guys tuning in today. Hopefully you enjoyed the stream, and hopefully you learned something. You know what I say, man. Invest in yourself, guys. Obviously, education is the number one thing that you can have. Do appreciate all the new members of the group and all the existing members of the group. Thank you for each and every one of you for showing your support and making our third weekly stream possible. Been really enjoying our Friday streams. So you can always check out the streams every Wednesday and Sunday at 8 p.m. Eastern Standard Time. And then also on Fridays now at 11 a.m. Eastern Standard Time. Typically run about 2 hours. Obviously went a little longer today, 2.5, but I think it was worth it for that extra little bit at the beginning. So, and I will keep doing, at my convenience, some clips and just putting out like snippets through the week. Obviously, you guys don't care because you're already here, but just know when I put out those static videos, they're just parts of like the stream from the day before or whatever. Just some people don't want to watch a 2.5 hour stream. They just want to see a quick little something on crypto or a quick little something on why J Powell's a bitch or, whatever. So if you watch a full stream, you don't really need to watch those. You can obviously click on them, give them a like, show your support, throw a comment on there. But it's really just a clip from the stream. So, but yeah, that's it. We did it. We talked about some very important stuff today. Talked about the trend, how to position ourselves. Basically a lot of bullish moves right here. I think that we got to be real careful that we don't get trapped. A lot of people will be looking to unwind positions or be FOMOing in and getting stuck in positions. So, definitely want to be the one who's unwinding, in my opinion, not the one getting stuck at the top. So sorry about that. I hope I didn't just like cough straight up in the microphone. I had to clear my throat. Got that good old frog in there. So, but yeah, that is it for today. I appreciate each and every one of you for tuning in. But that is going to do it. So, just a reminder, that's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. You know what it could be? One of those kernels, popcorn kernels from eating that popcorn, watching that Fed meeting earlier today, scratching up my throat a little bit or something. But yeah, that is it for today. I appreciate you guys. Take your time, rewatch parts of the stream if you need to. You know, if you have any questions or anything like that, I'm always willing to elaborate on any of those points. Obviously, if you want any particular assets looked at, just let me know, shoot me a message, an email, whatever. Everything's been going pretty good with the new group members. Everybody seems to be on the same page. Haven't felt like it was like overwhelming or I had like a bunch of ridiculous questions or I wasn't paying enough attention. So I will probably go ahead and open the group back up maybe, I don't know, at the beginning of next month or something like that, for a few more people. So I have a couple of people already on the list, obviously. And then if I haven't messaged you back, I will message you back. Sorry, just been busy. And then, yeah, I'll probably let a couple more people in because everything's been going well. So if you are interested in that, reach out to me. I'll get back to you with the details. If you already reach out to me, I promise I will get back to you if I haven't already. Yeah, so that's it for today. Appreciate each and every one of you. Everybody have a good evening. Take care of yourself. Educate yourself. Love your family. You know, prepare for the worst and hope for the best. But make sure that you spend some time doing that research, preparing for bullish and bearish case scenarios. Make sure you have some invalidation levels, mastering position sizing, risk reward, probability of success. And that's going to give you the most likely outcome that you desire and some kind of edge on the market that will turn this from, you know, essentially gambling into, you know, investing, trading, whatever. So that's what it's all about. Hopefully you guys are learning lots, tuning in. Appreciate all the positivity. And that's it for today. Crypto Trend Trader. It is Wednesday at 10:40 p.m. Eastern Standard Time on March 16th, 2022. And I'm out of here.